We're
Do
unmuted.
they have like ads in between, like advertisement?
No. No.
Okay.
Do you want to call it to order and then I'll do roll call?
Morning, everybody. Call a meeting to go order for the Irish Commission Fund at 10 o'clock.
Okay, roll call. Mark Lenedy, Justin Campbell, Chad Branford,
Here.
Kenneth Sutton,
Here.
Art Leary.
Here.
We have a quorum. Please don't forget to turn on your mic when you go to speak. Thank you. And turn it off afterwards. All right.
All right. Good morning, everybody. Everybody had a chance to review last meeting's minutes. Might have a motion to accept the minutes.
Motion to accept minutes.
I second. Motion by Mr. Leary, second by Mr. Sturman. All in favor? Aye. None opposed. On to solid gas. Good morning, sir. Good morning, everyone. Morning. Do I have this on? Oh, no.
Good morning again. My name is Leerdon Ida, Portfolio Manager at Sawgrass. First of all, before I begin my presentation, I'd like to thank you again for the business. We appreciate the opportunity to manage your portfolio. It's an honor for us. So this morning, we're here to talk about the quarterly performance review for your fixed income portfolio. Before I begin with the details, let me give you a quick sort of an update on what we're seeing in the market and the economy. I believe we're in this kind of a critical juncture where we believe that the Fed has paused and it's pretty much done with the rate hikes. The inflation has peaked. We saw the peak last year at roughly 9%. But so the trend has been coming down steadily, and we're basically now at the 5 handle, and we're projected to hit inflation near 3 by the end of the year, and probably by the end of next year, we're going to be back to that normal range of what we expected over the years in that 2+% inflation. If I look at the signs of the economy, the leading indicators are pointing to the economy slowing down dramatically. I should say, the non-farm, the ISM data, the manufacturing data, the new orders. Whether you look at the trucking rates, the container rates, the housing index. These are all leading variables that basically tells us what the economy is going to look like going forward. A lot of these variables are pointing to the economy slowing down tremendously. And there's more signs that inflation is going to decelerate faster than what everybody has expected. So our view is that we're going to hit a soft patch with regards to the economy, and we should see a range-bound market, at least in the near term, with regards to rates. And we think that owning a high-quality asset class like a core fixed income asset class, we believe that that's a good place to be, at least over the next couple of years. With regards to your performance for the quarter on page 9, we had a decent bounce since the beginning of the fiscal year. So if you look at the performance fiscal year to date, we finished the quarter up 5.8% on your portfolio, handily outperforming the benchmark, which was roughly 4.9%. So we outperformed on the way up. If you look at the last year, unfortunately, last year was a dramatic year for bonds. We had a big sell-off. We wanted to protect more, but it was very difficult given the speed of the sell-off that we experienced. But even in a down market, we did protect your portfolio. So we're trying to basically be active on both sides. In a rising interest rate market, we had a negative turn, but we did outperform the benchmark. But also on the way up, with this bounce in prices and the bounce lower in yields, we still outperform the benchmark. So we're trying to be a bit more nimble there and trying to generate some excess return for your portfolio. So that is kind of the view there. If you look at the 5-year, still, even that, what we saw last year, that huge sell-off in rates, essentially took out the gains that we experienced for the last few years. So on a 5-year basis, you're still at a positive number. And this year is actually looking pretty good for your portfolio, 5.8% as of 3/31. What's interesting here is that I'm just going to jump right to the characteristics page on page 16. Going forward, as I mentioned to you, you've got a pretty decent yielding portfolio, 4.5%, which might not be a lot, but given the historical levels that we've gotten used to in the past in the last decade or so, 4.5% for a high quality asset class, that's actually, in my opinion, that's a pretty good deal. It's a decent carry. It's a good diversifier for the rest of your risk asset portfolio. And so we think that that's a good it's a good place to be, at least for the next few years, given how the economy is expected to perform, how the inflation is expected to normalize, and what the path is for the Fed going forward. In terms of the activity, we've been, as I mentioned, we've been a little bit more nimble there. We took some steps. We dramatically reduced the exposure to the financials, more particularly the regional banks, before we started seeing this sign of distress in the banking space. So from that standpoint, we actually got that call right. Not that we saw the stress coming, but just given our approach that is usually a risk-conscious approach, but also being mindful of relative valuations. We thought at the time banks were trading relatively rich versus historical levels, so we reduced the exposure there by about 30%, and that really paid off. Given what we saw back in March. So we turned in the near term, we turned cautious on banks, given the dynamics of what the Fed is doing. The fact that nowadays it's much easier to move the deposits away from banks, and given the opportunity costs for a lot of people, they see 5% in money markets. It's much easier, more compelling to move the funds much faster these days. And that's something that is really hurting the banks from an asset and liability management standpoint. So in the near term, we're cautious on banks. That is one part of the problem. The other part of the problem is also the CRE exposure, the commercial real estate exposure. That is, we think that's the next shoe to fall. And a lot of these smaller regional banks, they tend to be more heavily exposed in that part of the economy.
How are they structured? What is the exposure?
Typically, the mega banks, the money center banks, Wells Fargo is probably the highest one, and that's in the high single digits. But if you go down in the lower market cap space, we're talking the key banks of the world, America, Synovus, these are like the smaller tier banks. They tend to be more exposed, 20, 30, 40% exposure to the total book. So that's something that, and then you have to be more granular, is the exposure in the industrial space or primarily office space. We think that the office space is probably the weakest link within the space of the CRE field. But nevertheless, that market hasn't really discounted the fact that we moved from 0 to 500 basis points in the Fed funds rates. The cap rates have increased dramatically, and they're not really marking to market their portfolio to the reality that is today. So that's something to be cautious of. But again, from a credit standpoint, you are in good shape because we have no regional exposure, and even in the money center banks, we've pared that down dramatically in the last few months. So if I was to point out in terms of where the weakest links are, keep an eye on the regional banks. And again, it's hard to make the case that to go from 0 to 500 basis points in less than a year, given the fact that we are most levered ever, relative to our historical trends. It's hard to make the case that we're not going to have any accidents. Everything's going to be nice, hunky-dory, move on. We should expect some more accidents along the way. So that's something that we're being very cautious and very mindful of. Prioritizing liquidity is a number one priority for us. But also we're starting to see some relative value pockets within the bonds. One of the areas actually is agency mortgage-backed securities. That is an area that everybody's been selling, thinking that the Fed is going to continue with quantitative tightening, being forced to sell their book of mortgages. So the spread in that part of the market has actually underperformed, meaning has actually widened, increased. And we think that given the steep discount prices, which means that you don't have that prepayment risk, so people are not inclined to refinance because they're completely out of the money. You're getting that extra carry, and it's actually guaranteed by the government, by Fannie Mae. So you don't have the credit risk, and the principal and the prepayment risk is actually extremely minimized. So we think that's actually a great place to be, to have that extra carry relative to, say, in corporate bonds. So that is something that we're starting to increase the exposure. We have increased the exposure over the last few months. We actually turned overweight recently, but we think that's actually a good relative value place to be.
What is the spread?
If you look at it on an average to life base, average spread to average life is roughly about 95, on a discounted coupon. On a current coupon, on a current production, we're talking 150. But if you adjust it for the optionality on an option adjusted basis, it's in the mid 50s. So which is not bad given where everything else is trading. So those are some of the things we're doing at the margin. In addition to trying to get the call right at the economy, at the interest rate risk level, when you dig down into the security selection, the sector allocation, those are the types of things we're doing for your portfolio to further increase the excess return.
Can you talk about M2 and why it's been shrinking, and give us some history on how it expanded so much, and perhaps that was the root cause of this inflation, and how are they going to get the M2 down further?
Yeah, I mean, the M2, we saw a historic move, post-COVID, right? We've never seen anything like that in the history of our country. The increase, year-over-year increase of M2, 21 to 22, it was historic. M2 is the total aggregate measure of money supply. It captures not only bank liabilities, but it captures cash, which is the medium of exchange unit of account, captures money market funds. So if you aggregate that total supply, that essentially is the oil of the economy, the Fed is in charge of that supply, right? So they were purposely increasing the supply to try to liquefy the system because everybody got so scared about COVID, we didn't know what was going to happen. We had this once in a lifetime period where the fiscal policy and the monetary policy, they merged. Essentially, it was a one entity. Fed monetized this huge extra debt that the fiscal policy implemented by issuing checks to everybody. Everybody received money, PPP loans, income security programs, you name it. All, airlines, everybody got extra money. Well, how was that money created? Well, it was created via this new debt that was funded essentially by the Fed by printing more money. So in hindsight, it turns out that we actually overdid it based on the current metrics that we're seeing. We should have been a little bit more cautious there, but that's history. But what's happening now, to the purchase point, is that that the M2 supply, it's actually shrinking, that's a first. We've never seen a shrinkage of the M2 on a nominal basis, meaning
It's never been this big to shrink in the first place.
But even though it's shrinking, to your point, it's going to take a little bit more to bring that supply back to that normal trends, given where our economy is.
So you mean the Fed's reeling that money back in?
Technically speaking, yes.
How are they doing it? By selling securities?
By reducing the quantity of their portfolio.
They're selling bonds.
So they're selling bonds, or they're letting bonds mature and essentially killing that supply, not burning it up, not circulating.
As their bonds mature in their portfolio, they get $1 billion in mature in cash that comes into the Fed. They put it into a furnace and just burn it.
It gets excluded from the
That's
circulation.
what they're doing.
They're literally just
They're
reducing
burning
the amount of dollar bills that are.
Burn them.
Right. As the securities mature, right, it's not going to circulate.
Seriously, they're burning it.
Yeah.
It's crazy.
Well, and it's interesting is that in addition to the Fed engineering this reversal, if you will, if you look at the senior loan survey, senior loan officer survey, which is the main gauge that tracks the bank's willingness to lend, but also the trends of that. Banks, because of what happened in March, banks have also turned one notch extra cautious. So they're also withdrawing liquidity, withdrawing credit from the system. So we have the M2 supply shrinking, the overall loan aggregate amount from the banking system shrinking. So that leverage is actually coming down fast. And we're starting to see cracks in the home goods section. We got a glut of inventory from the main retailers out there. So definitely on the manufacturing, consumer goods side, we're starting to see actually recession. What's holding the economy up right now is the services part. But again, the services is not as cyclical. The amplitude to the economy from the goods side, it's actually 6 times greater than the services. So if you have a recession on the manufacturing side, even though it's a smaller portion of the economy, it does have a tremendous effect in the overall economy. So what I'm trying to say is that going forward, at least in the near term, we're going to start to see some cracks in the economy, and we're actually positioned for a higher likelihood of recession than what the average street is.
So in real simple terms, for a guy like me,
Yeah.
will that mean that as those bonds sell off and they get rid of them, the value of those bonds will go up. What's left over?
So what happens in that case is that if you're, as they mature, they suck the liquidity out of the system. Then all of a sudden the money is tight, the liquidity is tight. And typically when you see a sign of tight money, that is commensurate with rates moving actually lower because the economy needs more oxygen. It's not getting the proper oxygen, and then we're going to have an accelerated phase of the slowdown, if you will. So we should expect lower rates in that type of environment, and probably wider spreads and risk assets underperforming significantly.
How does the increase in the debt ceiling impact the bond market?
It depends on how they're going to fund that new supply. So what happened with the debt ceiling? They signed a deal and they got a blank check. There's no limit for the next 2 years. You spend, if you want to spend like a drunken sailor, go ahead and do it. So what happens there is, so they're projected to have an extra $1 trillion plus of new funding for the next 6 months. And the question is, well, who's going to fund that new debt? The talk there is that they're going to try to target the shorter maturity part of the spectrum. So in other words, they're not going to go for a 30-year new issue, but they might go for a 6-month T-bill because they find that there's a lot more demand on that part of the market because you got so many money market funds and there's other intricacies within the Fed's equation that, like the reverse repo.
Would that push down the value of the 6 month?
That would push down the value a little bit, but the sensitivity there is so small that it's not gonna matter much. So they're gonna try to be more tactical than normal because of the extra supply that's gonna hit the market. They don't want to put too much of a term premium back into the market, so they're gonna target the shorter term maturities. And the net result of that is that we shouldn't expect a big movement in the longer term rates. And therefore, mortgages, which are tied to the longer term rates, shouldn't be too much affected in that operation. But the net result of that is, I would argue that because of this debt ceiling talk, what happened there is that the TGA, which is the Treasury General Account, that is the general account that essentially funds all the discretionary spending, that also came down almost close to zero. So they basically depleted that entire account. And what happened there is that all that money was essentially doled back into the economy. So the risk market, the stocks, they got this extra juice of liquidity because the government wasn't borrowing, wasn't taking liquidity back into their coffers. So what's going to happen with this new program is they're actually going to reduce the liquidity by borrowing, if you will. So you have to think in cash flow terms. So they're going to take cash away from the economy to fund their programs. So the net result there is, in addition to this new supply, I would argue that the overall liquidity might actually be affected to the negative side for risk assets, at least for the next 6 months. So overall, my opinion is we continue to be up in quality. The bonds offer a decent diversification given what the current trends are in the economy, and the carry is actually pretty good. 4.5%. It's not bad at all given the historical levels of rates. Any additional questions?
I just have one more. Are you almost finished?
I'm
You had more questions?
I'm done with my presentation. So if you have any questions?
The credit spread, which historically has been a useful gauge about direction of the economy, slowing, accelerating, whatever. I know it's still pretty tight. Is that expected to widen further as we go through the year?
Yeah, as we go through this patch of volatility, we should expect credits to be a little bit more volatile, and I would expect some widening, meaning the credit relative to Treasury, which is a risk-free asset class, to underperform. What's happening recently, to the surprise of many, because a lot of people were positioned for credit, corporate bonds, high yield, anything that has a spread to Treasury, that's called credit. Well, that is not government guaranteed. So you're basically taking credit risk. And those assets, they trade on a spread basis. So that spread is highly correlated with the overall risk sentiment. So stock market, think about it in those terms. Recently, we've seen spreads be in a very, very narrow range, which means that there's a confidence to that market that everything is fine. There's no need for there's no stress from that standpoint. Part of that, what's going on is that a lot of these companies, a lot of corporate America in general, they took advantage of the very, very low historic rates that we saw 2 years ago, and they turned out a lot of the maturities. So a lot of these companies have 20, 30 or 30-year debt. So in other words, they don't have to face this period of very high interest rates to refinance the roll of their debt. But a lot of that is coming due. So we should start to see some kind of stress there. And especially if I'm making the case that the economy is going to decelerate very, very fast in the near term, we should start to see some pockets of volatility with regards to spreads, especially for high yield.
I just want to circle back to the mortgage, the agency discussion earlier. But you're saying the market has kind of moved away from agencies for a while, and that's why the spread has widened.
It's a technical base, but yes.
But if the consensus is that rates are going to start to go down sometime say in the next 12 to 18 months, why would the market already be perceiving that value in agencies? Why would they already start? Why are they so distant and reluctant to go into agencies like you're suggesting?
Yeah, I mean, it's all technical based, I would argue. Part of that is the uncertainty of what the Fed is going to do, and we are not 100% sure that the inflation is peaked, so we don't know that for sure.
Okay.
The other part of that is also what happened with banks in March. We had a handful of banks that failed. If you factor in the aggregate assets of those banks, they dwarf the amount of banks that we got that failed back in 2008. So what happens in that case, for example, with regards to Silicon Valley Bank or First Republic, they go into this kind of a regulatory procedure that is managed by the FDIC, and then they try to find the best bidder that is going to bid the failed asset of the assets of the failed bank. What happens in that case is you have this kind of a forced liquidation. So what they do is they try to liquidate a lot of their assets. And so we saw that, after Silicon Valley Bank failed and First Republic Bank failed, we saw a list of all their holdings being placed up for bids. So what happens there is that you get this wave of new supply that puts more pressure in the spread. So part of the reason why the spreads haven't factored your thesis yet is because of this other potential, tail, if you will, of we don't know what's going to happen in the banking sector, where you might have more failures, and therefore that can bring more supply into the market.
Thank you.
All right.
Thank you, sir.
Thank you.
I have a motion to accept the report. Motion to accept the report. All right. Motion. Second. Mr. Leary. All in favor? Aye. Next up, Mr. Maverick.
Hey, good morning, Dwayne Madron, Capital City Trust, and I too would like to thank you for being a client. And I think Jill's putting the report up on the screen. And if we can page down to the policy review section, we can look at the fund, how it's positioned according to the policy. So currently, as we have been, we're underweight in large cap and international equities by about the same amount. And I'm doing that in an abundance of caution due to the uncertainty of the economy at this time. And I'm also a little bit overweight in bonds because they've become cheap and they're better asset to use for defense at this point. And I'm also overweight in cash because our cash money market is yielding 4.5. So it doesn't really hurt to stay in cash, and that's a little bit of dry powder in case the market pulls back. If there's any questions on the positioning, again, underweight equities a little bit at the expense of being overweight cash and bonds. There's no questions. We can go on to the performance for the first quarter in March. This is the equities that we manage for you. The year-to-date column, by the way, is the fiscal year-to-date. So this is interesting. Fiscal year-to-date, the equity side is up 13.5%. The equity portion rallied 15.4 since September. And high yield bonds were up 8.2, handily outperforming the Bloomberg Ag Real estate came back 6%, and then cash, as you see, is starting to return better than it has been. So what was the theme of the first quarter? And I call it a comeback theme. A lot of the aggressive growth technology stocks that were sold off in 2022, the Googles, the Amazons, the Microsofts, the Teslas, the Netflixes, the Nvidias, this other semiconductor stocks were sold off so much that in January, the market said, hey, I'm starting to feel better. I see inflation moderating and earnings are starting to look better. And all of a sudden, money started flowing back into these stocks that were sold off in 2022. So lo and behold, technology stocks year to date are up something like 20%. And that was largely due to the large tech companies like the Microsoft, the Google, Apple, Amazon, and also because there's a new theme out there now called artificial intelligence. A lot of companies are getting into that, and that's causing a lot of excitement. It's not completely here yet, but it's driving a lot of stocks up, which are helping push the stock market itself up. So between the comeback and the artificial intelligence and the moderating inflation, we had a great quarter for equities in any asset class that's related to equities, and that's the ones that Burgess chose in his model, like the high yield bonds and the real estate, which tend to perform equity-like. So you really have a portfolio that does well when the economy does well or when stocks do well. So in the first quarter, your stocks did well, or any investment that's stock-like did well. And REITs or real estate investment trust are an example of that. So, the latest 1 year still negative, still fighting to come back from that awful year we had last year. If you turn to page 5, pages are numbered at the bottom right. We have April's return. You can see we're year to date, fiscal year to date, we're up 14.2. So it jumped another, looks like 70 basis points in 1 month. And stocks were up 16% fiscal year to date. High yield bonds up 9.5 fiscal year to date. So the portfolio is back on track, doing its job, making up for lost ground. I'm still a little concerned about what's going to happen this summer, and that's why I'm underweight in stocks. But in the long term, we manage risk by having a long investment horizon, and that helps us to ride out the bumps with the assumption that the good years do better. There's more good years than there are bad years. So that makes the volatility of the portfolio go down. So year in and year out, you may experience volatility, but on the 5 year, that volatility is much lower. If you use a 5 year average. There's no questions on the performance. I can go on to page 7, which is a snapshot of the account as of May 22nd. Market value is 8,041,215 and 61.3% in stocks, 28.8 in bonds. So it's a moderate growth portfolio. It's not at the top of its range, and I'm letting it float up. And then the next page, page 5, is a listing of the funds that we use. Page 9 is the Sawgrass Fund and the high yield bonds, and then the index, REIT index at the bottom. So it's a pretty simple portfolio. I stay close to Burgess's model, maybe deviate just a little bit. Any questions?
I do. Do you have any? So this is this program. I think you're doing a great job, and it's an open architecture program. And I think in the early days, when the bank was picking stocks, it became apparent that, and this is a problem that I think the whole industry has, beating the index is a challenge. So your value here, I think, has been very successful in being tactical at the right time, strategic, in emphasizing or de-emphasizing the different asset classes in place here. You you mentioned the simplicity of the program. Do you have any suggestions? I didn't prep you for this, but do you have any areas that you think that we ought to explore adding to the portfolio?
I'd like to add active management to high yield bonds. A lot of times fixed income managers beat their benchmark. And I think I can find one and I'll talk to you. about
Okay,
it.
very good. Very good. Any other, how about, does your bank have any interest in private equity?
No, because it's illiquid.
Okay,
And it's, as a fiduciary, our auditors like to see daily pricing.
okay,
Uh,
I would agree with that.
But, you know, small caps are a proxy for private equity. They may not do as well, but they're growing fast.
And you have liquidity. Do you have anything else you want to add on the asset classes? Okay, thank you.
Thank you. Thank you.
May I have a motion to set the report?
Motion.
To set the report. Second. Motion second. All in favor? Aye. None opposed.
Good morning.
Good morning, sir.
Just driving in here this morning, I can see changes. It looks like there's a dry stack marina under construction on the, just as you're coming into town from San Mateo. That'll be a big operation there. In the banker.
No, I have no idea before, but I hope it's successful. Lots going on in town right now.
Yeah, that's good.
Lots going on.
That's good. So just to pick back up on the program, this is a relatively simple program. I must say that $7 billion that we oversee around primarily in Florida. Some of the larger plans that say are $400 or $500 million plans, have tended to want to get into more esoteric asset classes, meaning they don't correlate with the stock market. They kind of have their own little tune that they follow. Stocks go down or go up, they don't seem to move in the directionally with the stock market. And I mentioned private equity, but I will caution you that, and everybody who's listening, that private equity has its pitfalls. It's been a very popular theme for the last, really, especially the last 15, 20 years. And but it's hitting a rocky period now because it's an unregulated area of the market. As pointed out, it's not, the valuations of these private companies are unknown, and the performance is projected using internal rates of return, which is a concept that really is meaningless considering you're getting so much of your capital back. And with so many players in that space, many of these private companies have been purchased at an enormous premium. People have overpaid for them. And now that we have rising interest rates and the economy is feeling the headwinds of the slowdown, those, I would call them mispurchases, are now coming to roost. And now these companies, private equity general partnerships, are finding themselves with these big baskets of assets or companies that they bought in the last 5 years. Let's say they paid too much for them. Now what? So they have to be marked down. They have to be priced down. And the industry is reluctant to do that. And so they're getting a lot of criticism from investors in that regard. But you're not in that space. Beautiful. We should take you there. Page 1 has already been covered about the banking malaise and where we go from there. I'll go to page 4, summary. As is pointed out, the last 2 quarters have been very strong. And that's why the fiscal year to date overall plan performance net of fees of 793,000 or 9.5%. I think as we speak, you're probably up around 10.5%. The S&P is up around 12 now. And so if things just stayed where they are right now at 12%, you'd end up having a very favorable fiscal year. Now, very interesting history on page 18. I'll come back to one, but page 18, this is an illustration of how the retirement plan has performed each of the fiscal years, beginning with beginning with 2005, and we only had really one really terrible fiscal year prior to 2022. That was in 2008 when you were down 8.7. I should mention the FRS was down a lot more than that, probably twice as much. The most recent year, 2022, you were down about 16.4. That's because of the equity exposure and bond exposure. Very unusual that they both went down so much. But what we know is that based on history, when you have these big down years, there's a better than 75% probability that the following year is going to be much better. We're already seeing that. And that's why I'm thinking 12% is a reasonable expected return for fiscal year 23. While we're here on page 17, you can see the 3 and 5 year returns and risk profile. Results have been right in line with the strategic model. And that's due to careful monitoring and rebalancing and so forth. On page 16, we talked a little bit a while ago about the massive expansion of the M2 money supply that was nicely defined for you. And you can see how the plan performed beginning at the bottom, which is the first quarter of 2020. That's when the pandemic was really on everybody's mind. And all that expansion in liquidity, money pumped into the system, people getting money directly, that's pushed this value of this program up to about 10.3 million. It happened very quickly. And then once the Fed announced, once Jay Powell announced that party's over, you can see how quickly the market came back down. Both bonds and stocks collapsed last year, but it looks like this adjustment, this repricing will be fairly short-lived. When we had the big crash recession in the 89, 90, 2008, 2009 period, that dragged on for about 18 months. This decline lasted about 9 months. So a lot of big magnitude, but it's happened in half the time as the past downturn. Back to the beginning on page 4, summary remarks.
Why the quick recovery? Just why a quick turnaround?
That's a good question. I think it's a combination. You guys please weigh in on this. I think it's a combination of policy being implemented faster and just the sophistication of markets and trading platforms and so forth. Better information. You want to weigh in on that? Why is this adjustment so much quicker than the other big adjustment?
Part of that is also the variable lags that we tend to feel after the Fed makes these moves. Usually start 6 months from the point of that move. In this case, that variable lag has been actually deferred. So some of that is, it's part of the fact that we haven't felt those variable lags yet. So that's why that, this big quick bounce in response.
So in the next one that you're predicting is going to be a slowdown, do you predict it to turn around? I mean, is there a way to know the way this position?
Ask these guys.
I mean, yeah, it's a bit. everything was basically tied to the inflation. If the inflation is going to normalize and the Fed will normalize, they're inclined to maintain the level of assets to an optimal level. They don't want to crack the economy. So the inflation is the big wild card.
And I'll add one thing. The nice thing about your portfolio is a lot of your money is in large US companies with diversified revenue streams, and they're able to raise their price and ward off inflation because they have products that people want, like the iPhone. And earnings, this last earnings season were better than most people expected. So one theme now is, are earnings going to be better this summer than people think? Are we going to hit an earnings recession or not? And so the market is recognizing that earnings are better than they were, and that's part of the reason you see stocks going up. That there's other reasons too.
Well, it seems like there's, I know folks I converse with, as part of this reason, folks want to get away from volatility of the stocks and stock market in general, is because it seems like we're seeing more downturn more often. And I know now this period right now seems to be not the case, but it seemed like it would take longer to regain that and then exceed what you were earning before. So we're seeing a lot of people, like you mentioned, I think, Dwayne, people coming in, opening those type of accounts, CDs, IRAs, those type of things, because they're willing to take 2 or 3% over losing a quarter and a third of their investment principal.
Right.
So that's kind of what we're seeing. So I'm curious how you guys would forecast another downturn and how quickly that may come to us. And for us to be prepared to hopefully have a quick turnaround like we're having now.
Well, let me make, if I may weigh in on this first. The beauty of the allocation model, which you can find in your books on page 8, is that historically, when we have had these big downturns in the stock market, we don't know exactly when they're going to happen. But when they do happen, the bonds historically, 95% of the time, the bonds have actually, you mentioned people looking for safety with cash. During downturns, the bond market collects a lot of money. So the bonds go up in price. So we have that counterbalance. And then what we do is we did this in May of 2009, the bottom of 2009 was in March. But what we did here was we moved money out of the bond portfolio and we started buying stocks again. So that rebalancing mechanism, when one side or the other becomes overweighted, has been the hallmark of this program since I've been involved. And that's really the only way we can do it, because the second part of that, which Dwayne mentioned, is emphasizing large quality companies that have sustainable business models, and they're not going to go out of business.
Yeah, certainly bonds are competing with stocks, 4.5%. A lot of people are happy with that. So I can buy CDs at 5.6. Why would you use stocks if you get 5.6? So that is certainly something that we haven't seen in a long time. But technology stocks, because they grow at 20 and 30% growth rates, are attracting the money, because that's where the valuation can be justified. And the stock market is made up, 26% of the stock market is technology stocks. So that's a big chunk of the stock.
Even now with like these banks that failed. Now, my understanding is they were heavily engulfed in tech companies and doing business with those tech companies and seeing some of those companies have major layoffs and they're not selling as well. I'm amazed that people still kind of want to pursue that. I could see it pursuing, companies like Apple and whatnot, but, it just astounds me because I've seen, folks here that are come out of the drop program, with the school system and lost hundreds of thousands of dollars. And they're looking for any and every way to get away. I've seen some pull their entire portfolio into bonds and then place cash in these long-term CDs with, 4.5% rates, because they're willing to accept that rather than the risk.
But their goal is not 7.2%, because they can't get that from the CD, but you all have a higher goal. So stocks have got to be there. And because you have a long time horizon, you can afford to ride out the bumps. They may not be able to because they have to live in it.
We're talking about individuals who are dealing over the short term in the scheme of things, where we're dealing with a life.
Very long, yeah, perpetuity. That's how what I.
I mean, the duration of your liabilities is much longer. It's than to think long term, sure.
Thank you.
That's it. That's all I have today. Thank you.
That was short. I have a motion to accept the report. Motion is something for it, right? Second. Second. All in favor? Aye. Thank you, sir.
Thank you. Thank you for your service.
No, it's not Miss Anna. Is it Miss Barber?
Yeah, it's Lindsay Garber.
Hi. Hi, nice to meet you all. I'll be covering for Anna today. Just have a couple items to go over with you guys. The first is the subscription for death checks proposal. So I believe you have that in front of you. Anna had talked with the folks at PBI and she looked for a proposal for all three plans. The minimum invoice is for 500 participants, so they won't go any lower than that. And that invoice would be for $3,500 per month to be split amongst the plans, which comes out to about $1,166. They, just for some process, they run reports on Monday and give responses by Friday. The stated contract term of $3,500 would be for the year. And we've worked with this company before. They have other, plans that are clients, and they do a pretty good job. So I don't know if you guys have any specific questions. Anna is meeting with the other two plans today, and we'll discuss the same proposal. So if you like this idea and you're comfortable with the price, you can approve it, subject to the other two plans also approving it.
I have a few questions.
Okay.
So, Ms. Jill, maybe you can help me with this.
Sure.
How do we currently make these inquiries now?
Some of the time, the bank itself will inform me if they think someone has passed. And because they do have some kind of service that lets them know. Usually it's either in the local newspaper, and Sunny, our city clerk, is actively looks at that every day, and the families approach me. Now, in a year, I haven't seen the fire department have a death in several years. Now, they're the smallest of the pension. There has been maybe 2 deaths in the police department since I took over 5.5 years ago. And it's mostly the general fund because it has a much larger base. But even then, maybe 2 a year deaths in the general. I think this is a steep cost. And although it might have been an issue in the plans that, where they had fraud, I really don't think it's that big an issue here. But this would be pretty costly for the plants.
If we went unnoticed, Ms. Jill, if it went unnoticed, what would happen? Say it went unnoticed for a year and somebody collected that check. What would happen in that case to the person or to the monies?
Then it would go to the pension attorney to follow up with letters and try and collect it back.
Yeah, we-
Go ahead.
We've had an issue in the past with another client who there was an overpayment for 16 months because they missed the death. And sometimes you can get the money back, sometimes you can't. In this case, we settled for getting half the money back. But it usually requires some, like Jill said, legal letters. It could require litigation. Depending on how much money it is, litigation might not be worth it because the fees could outweigh the overpayment. But we have had those things in the past where we've tried to claw it back. It's not an easy process.
And I do send out every July, I send out a letter to every retiree where the retiree has to go to a notary and get the letter signed that they still live at the same location, that they have the same phone number and everything. So once a year in July, I send all the letters out and then I get them back. Now, not everybody sends them back, but that's our attempt at making sure that they're alive and well at that point. It's called an alive and well letter. So if I don't get it back, then I send a certified mail to that address. If I don't get it back, then, there's the threat in the letter of your pension being stopped until I get a response. Now, I haven't followed through on those threats at all, but it is in the letter, and the letter was written by the pension attorney, so.
And you will generally get a response when that happens?
Yes, sometimes those who cannot get to a notary due to illness or incapacity, they'll give me a call at least. They'll explain the
How many
situation.
of those are outside of the county?
At 10th, 90% are in Putnam County.
The other question I had was, I was trying to understand, do they monitor current employees as well? So are they monitoring?
Well, I'm responsible for all the money that you're putting in. I have to track all the money the city's putting in. So yeah, I track 372 people as far as where they stand on their pension. And
So that's kind of an uninformed dumb question. Are we paying them $3,500 to check the obituaries every day? Right.
That obituaries is part of what they check. They also look at, social security lists, which I think accounts for about 23%. But I do think they look at all obituaries daily. Yes.
I know there's other.
yeah, the Social
Facets of-
Security Administration as well issues information.
Could we say, let's wait and see what the other committees do?
We only have.
Would now be the time when we're actually gonna make a vote on this?
Well, yeah, if you wanted to be a part of it, it's going to go in front of all three. In order to share the price,
Right.
all three would have to. I mean, and even then, if they want a minimum of 500 participants, we're not there yet either.
They don't require 500. They just won't do a price for less than 500 is my understanding. And there could be something where it's split between the plans on a pro rata basis. So if the other plans agree, right, if fire has less people, maybe it's not a third split and it's based on the amount of participants.
So that's $42,000 a year that we'd split.
I have one more question, if I may. Ms. Jill, have you found that we've had problems with this throughout our history? And do you know of any issues throughout our history?
No.
That's not just,
And that was, before I got here, we weren't sending out the alive and well letters either. So that was encouraged by the by the pension attorney. We started doing those.
We can table this until we hear from the other pension boards. I'm pretty well settled on it.
Yeah. If that's, we can table it.
How did this come up?
It came up because the pension attorney, Anna, I believe they're aware of a situation in South Florida where a guy got, a pension administrator got away with $3 million by changing the accounts on people who had died. He changed the bank accounts. He didn't let the pension bank know they had died, changed the bank accounts on him to his account.
That's
So
correct.
the money was going.
The firm had prepared a memo for all plans, just talking about their internal controls, just because this happened. And we made some suggestions of how you can prevent or how you can help prevent fraud in the future. And death checks was one of our suggestions.
We just need to watch everything you do under dual control.
Yes, yes, and that is something we do have here is, money can't be spent unless there's a second signature. At this point, it's the interim city manager's second signature on everything. Any money that I spend has to have a second signature on it before it goes to the bank, asking them to cut a check.
I think it's worth it. Not at this point.
Would now be the time to take a vote, still.
Yeah, I think if you've made your decision, then it'll go to the police department. If they think there's value, then they split it between the police and the general. If they don't think it's value, then it'd go to the general and they'd have to pick up the whole tab.
And you don't have to take a vote to not and just, simply not partake in it or say that you want to. Unless you want to be on the record, it's just not necessary to say no.
You guys had. So I personally, I certainly feel like it's worth to work with funds, in my opinion.
My guys, we have a fortune changing everything, and that's not true. I think about.
Yeah, I don't know. You don't want to stop. You just see mortgages. It's easy to track down measures if they were to change.
Yeah.
Thank you, ma'am. On to, you guys ready to move on? Let's move on to the House bill.
Okay.
Thank you.
Yeah, of course. I'll let Anna know. So the last thing I want to talk about is a client memo that our firm put out regarding HB3. It passed the state legislature and has been signed by the governor. It takes effect July 1st. It has a series of prohibitions on environmental, social, and governance targeted investment practices. So it requires that fiduciaries may solely invest based on pecuniary factors, which are financial factors, and that fiduciaries may not invest to further any social, political, or ideological interests. Those are the main takeaways. The voting proxies, the government plans must comply with those first two factors when any managers are voting proxies. Burgess, I think, can speak to if there are any social, political, ideological interests that are being factored into. The big thing I think that will really affect the plan are the reporting requirements. So starting this December and each odd number year thereafter, government plans have to file a comprehensive report with the state. We've been speaking with the state about this to try to understand what those reporting requirements will be. We've suggested to them if the plan can provide a certified letter saying that they are in compliance with the new law. The state has come back to us saying that wouldn't be comprehensive enough. So we've heard that over this summer, the state will be meeting to develop rules and regulations to help implement these provisions. So we do expect some rulemaking late summer, early fall. It could, require the plan providing an Excel spreadsheet of the different things that they own or invest in. It has to be in a digestible format because the state only has 30 days to submit a report that includes a summary from all local plans. So we do expect some type of Excel spreadsheet similar to how the annual report gets filed.
We expecting the state to provide a spreadsheet that
That is fillable.
Criteria?
We don't quite know yet. We're hoping that it looks something like the annual report. That looks like an spreadsheet. Keep in touch with them. We don't expect rules until probably September or October, but we hope that they make this somewhat easy to implement from a plan perspective, because it will be a lot of work on the local plans.
So the Palatka firefighters retirement plan is in compliance as we speak. There's nothing we need to do right now.
Correct. There's nothing you need to do right now.
Thank you.
And those are the two things from my report.
Is it gonna change anything about how we do business? Will this change the way we invest or?
I would let Burgess speak to that. I think it will mostly change how you are reporting things to the state.
Yes, ma'am. Thank you.
Yep.
I think it's premature to give you a definitive answer, but my impression is that it will put, in the end, it will put firms that we work with on notice. But I'm not aware of any of the firms that we invest in today that follow ESG principles, to be honest with you.
Thank you, sir.
You're welcome.
Now we have a motion to accept the information.
Motion to accept the customer report.
Second.
Motion by Mr. Leary, second by Mr. Sutton. All in favor?
Aye.
None opposed, Mr. Chairman. On to the 24 budget. Thank you, ma'am.
Of course.
So this is the budget for October 1st through September 30th, 2024. It did not include any new expenses, such as the death. It does include higher expected costs from Foster and Foster because they put new rates in place. Otherwise, everything stays about the same. So I would need a motion to pass this budget.
May I have a motion to accept the report as written?
Motion to accept the budget.
Motion by Sutton,
Second.
second by Mr. Leary. We're all in favor?
Aye.
None opposed, Mr. Chairman.
All right.
On to expenditures.
Highlighted in bold are those who get their contribution refunds when they leave the fire department and they don't qualify for, they're not vested.
Yes, ma'am. That's just normal.
Yeah, normal.
Refund of contribution, correct?
yep. The ARA is the real estate expenses, which were not budgeted this year because the budget, what we weren't aware of in June, that there were going to be those administrative fees from ARA. But I did budget for this year, which was SEI expenses, which we're not having this year, so they kind of offset each other. Conan steers.
I'll just take. Yeah, that's.
You know, this would be some.
I don't remember what year that changed, Ms. Jill, from 7 to 10.
I think it was, yeah, 16, because it was before me. I think it was right before me.
Anybody have any questions? As for the expenditure report. Ms. Jill, we need a motion to accept the expenditure report.
Yep,
Motion to accept the report.
Motion by Mr. Leary, by second by Mr. Sutton. All in favor? Aye. In favor, Ms. Jill, none opposed.
mhm.
Are there any public comment?
Nothing. Nothing that I'm aware of.
And any other business?
No.
Entertain a motion to adjourn.
Motion to adjourn.
Second by Mr. Sutton, all in favor? Aye. Meeting adjourned.
Thank you.
Thank you. Have a good day.
Thank you, ma'am.
Thank you. Thank you, guys.
Ms. Jill, thank you.
Yeah.
Welcome, everybody. Let me turn my mic on, that would help. Could we please have the roll call?
Roberta Correa,
Present?
James Norwood, Matt Newcomb,
President.
Scott Mass.
President.
Thank you,
We have a quorum.
thank you. Has everybody had an opportunity to read the prior meetings minutes? Do we have a motion?
Motion we accept the minutes as presented. Second.
All in favor? Aye. Okay, thank you. Then we'll move on to the Sawgrass report.
Right. Good afternoon, everyone. My name is Larry Dongita. I'm portfolio manager at Sawgrass. Before I begin my presentation, I'd like to thank you again for the business. We appreciate the opportunity to manage your fixed income portfolio. Thank you. But today we're here to talk about the portfolio review for the quarter. Before I begin with the numbers, let me give you a quick update in terms of what we see in the markets and the economy. It looks like the inflation has peaked. We can be very certain about that. We did peak at 9% last year. It's been trending lower ever since then. Now we're basically at that 5 handle. But all the estimates are for the inflation to get closer to that 3% by the end of the year and probably 2% by the next year. So that's kind of the expected path of the inflation. And I started with inflation because that has been the main catalyst that has pretty much shifted everything in the last couple of years. Has forced the Fed to be very hawkish. We went from 0 to 500 basis points of rate hikes in less than 15 months. That's a record if you go back in history. And to see that type of move, given the fact that we have a record leverage in the system, and to not see any major accidents, that is somewhat surprising. But those things they do move with major variable lags. So we'll see what could happen after that. But the inflation has been the main driver of everything. The fact that it's normalizing and stabilizing, that is a good thing. And that has also translated into your portfolio has had a decent recovery in the last couple of quarters. If you look, for example, on page 9, if you look at the fiscal year-to-date number, portfolios have had a decent balance, is up 5.8%, and rates have actually normalized because the inflation has shown signs of stabilizing. And I think with regards to the Fed is pretty much, we don't know yet if they're 100% done, but it's highly likely that they're going to pause in the next meeting, and most likely they will pause after that. So it's essentially, this is it in terms of rate hikes. What comes after that? What is the path? Are they going to keep it for a long time? Are they going to start cutting soon? Obviously, a lot of that will be data dependent. It depends on what happens with the economy. From our perspective, what we're seeing out there is we're seeing a lot of, if you look at the leading indicators, not the jobs numbers, not the inflation numbers, they tend to be major lagging numbers. But if you look forward, what we see forward, we see signs of the economy decelerating actually faster than what people think. Looking at, for example, manufacturing new orders, ISM data, all the soft data that is coming out, is coming very weak at contraction levels. Housing index has been very weak. Trucking rates, shipping rates, container rates, these are all leading indicators that are pointing to, a glut of inventory, a lack of demand. They're all at rock bottoms. Lumber is down, copper is down. These are all leading data that is pointing to the economy cooling off in a big way. So that gives me a sure sign that inflation is definitely in check. It's going to moderate faster than what people think. And we think that the Fed is done at these levels. So that has been one of the main reasons why we think the rates have are going to be range bound in the near term, but it's kind of peaked from the recent high levels. So with that in mind, we have increased the overall sensitivity of the interest rate risk to your portfolio as a way to be a little bit more active to generate some excess return in addition to what the market can provide. So that's kind of how we view the economy and how we view the markets. And with that in mind, in terms of speaking of the active approach, you can see here in the numbers that for the quarter, but also fiscal year to date, we did outperform the benchmark by a decent amount. But also in a down market last year where it was very difficult to avoid negative numbers because everything just sold off in such a big way very fast. We did protect your portfolio in the down market. So we're trying to generate alpha on both markets. In a rising rate environment, we did protect your portfolio in the downside, But also, when bonds go up in price, meaning yields go down, we also outperform there. So we're trying to be a little bit nimble, trying to find pockets where we see relative value, and that's been the extra activity that we have implemented through the portfolio. In terms of what we see, in terms of what we've been doing recently, is we've been actually reducing the exposure to regional banks. If you look at your holdings, you don't have any exposure in regional banks. We did that before the banking debacle started to kick in, back in March. Not that we saw the banking stress would happen, but just looking at the relative value where everything was trading at the time, banks were trading at very, very rich levels. So we decided to part ways with that. But going forward, because of what's going on with banks, the fact that they have a big exposure to commercial real estate, which we think that might be the next shoe to drop in the economy, and the fact that they still have a lot of problems with the assets and liability matching, which causes problems, for their books, we've turned cautious in that sector, and we are actually going to look to reduce the exposure even further. Where we see value right now is actually in the mortgages space. Agency mortgages, those are mortgages, securities that are backed by Fannie Mae, essentially by the government. They don't have any credit risk. They are cheap right now because the investors thought that they're going to be the first, set of securities to be sold by the Fed, because the Fed did communicate to the market that they intend to withdraw the liquidity, which means that they're going to start selling some of their holdings in their books. They own trillions of dollars worth of mortgages, and so the market was trying to front run that. So that's one of the reasons why they're a little bit more attractive than the rest of the asset classes. We think that the Fed will not do that. They're going to hold these securities to maturity. And oh, by the way, they offer a decent spread relative to everything else. So that's been an area where we've gone overweight recently. We see that as a very attractive asset class. And that's something that we're focusing on for your portfolio in the near term. To summarize, if you look on page 16, the summary of your characteristics, you have a 4.5% yielding portfolio. It might not look too high because you always hear the headlines, the inflation is 5%, or it was 9%. You have to keep in mind that those are numbers that have occurred in the past. What is most likely to happen going forward is that inflation is most likely going to be in that 2% range. So having a 4.5% yield, especially given where that market has been in the past several years, I would say a decade, that is very, very attractive for a high quality asset class that not only gives you a decent diversification for the rest of your risky assets, but at the same time, you're getting paid for, you're getting a decent carry. 4.5%, I would argue it's a decent number. So, the summary of this brief presentation is you get a high quality asset class, decent carry, some pretty good prospects for the total return going forward in the next couple of years. And it's a good high quality diversifier for the risk, for the overall risk portfolios. So that's kind of the path there. So we would expect a range bound market, rates to be kind of in that kind of a narrow band in the near term, but in the longer run, we do expect rates to ultimately go lower to where the natural equilibrium would be for the rates. So that's kind of our thesis. With that, I'll conclude my brief presentation. I'll take any questions if you have.
Thank you.
All right.
Moving on to the Capital City Trust report.
Could we get a vote to accept his report?
Okay, I'm so sorry.
That's
Could we, somebody make a motion to accept the report as presented?
Motion to accept the report as presented.
Second.
All in favor?
Aye.
Thank you. Moving on to Capital City Trust report, Mr. Madden.
Hello, good afternoon, Dwayne Madron, Capital City Trust. Thank you for being our client. When Jill's kind of put the presentation up. First quarter review, if you go to the policy review page, Jill, the pages are numbered, so this is page 2. And also, by the way, for the new members on the board, Ernesto Boyce is on the call. She's the administrator, takes care of the check issuing and works with Jill on various issues. So if you look at the column that says percentage of total market value, that's the actual position as of May 15th. So you can see where large cap and international equities are a little bit underweight by about the same amount. And that's at the expense of being overweight in cash and a little bit overweight in bond. So that's a cautious stance because of the precarious economy that we are in. Like Sawgrass talked about, inflation is moderating. We might have a recession this summer. There's all sorts of bugaboos out there that I'm sort of waiting till that goes away to raise equities up to the top of their range. So nevertheless, you still have a healthy dose of equities, and I'm within the range that the policy describes. Are there any questions on the policy stance? If not, we can go on to account performance, page 4. And this is the performance through March, first quarter. If you look at the column that says year to date, that is the fiscal year to date. Good news, we're up 13.75%. And that's the equity side, because Capital City manages the equities, Sawgrass manages the bonds, except we also manage the high yield bonds. I guess my point is that we've made great strides to recover what we lost in 2022, which was just an awful year for investing. And if I had a theme to describe the first quarter, it would be the comeback quarter, where the Rocky Balboa gets off the mat and starts to fight back. So what happened in 2022, a lot of risky technology stocks sold off, like Netflix and Tesla and Facebook and Nvidia. They sold off maybe 60, 70%. And in January 5th, investors decided those stocks have been sold off too much. And money started to flow back into technology. And the technology stocks took off once they saw that inflation was starting to moderate and that things were not as bad as they seemed. And then lo and behold, the theme of artificial intelligence appeared with Microsoft buying ChatGPT, and all the other semiconductor companies and software companies jumped on the bandwagon and said, I too am going to have artificial intelligence. So that sort of sucked all the money into the tech sector, which is now about 26% of the stock market. And so technology is up about 22% year to date, and that has helped the stock market go up. And you hold those technology companies like Nvidia, Tesla, and some others that are affected by artificial intelligence. So it's been a good first quarter, made back a lot of ground. You can see even real estate is up 6% for the quarter. High yield bonds were up 8.2, beating the Bloomberg aggregate index by 4.89. So high yield bonds did their job. The Burgess Chambers model does well when stocks go up. And that's what happened. Your model that you use with Burgess went up with the stock market. It always does. It's been doing it for years. So it's definitely an offensive model. And most years are healthy. Last year was not, but this year we will make back quite a bit of what was down last year. Any questions? Page 5 is just returns through the end of April. And you can see they're just a little bit better because March was a decent month. So 14.4 year to date versus 13.75 in March. So we've made progress again in March, in April, excuse me. And so earnings season just concluded about a week ago, and most earnings were decent, if not great, especially companies like Microsoft and Netflix has even turned their company around. Their stock has gone right back up to almost where it was. So fortunately, a lot of the pension funds money is in large U.S. companies that have diversified revenue streams and that can deal with inflation by raising their prices. For instance, every year, Apple raises the price of the iPhone. So there's inflation coverage for you right there. So I'm pleased with the way it's going. It was outstanding that most of the money that's invested had the best returns. Large US and international had the best returns. Small cap and mid cap had the least, but you had the least amount of money there. So I was pleased with the way it all spilled out. Returns to me are, with the exception of small cap, were good. Small cap usually suffers during a slow economy because small companies can't weather the storm as good as large companies. The next page, 2 pages over, which is page 7. We see the snapshot as of May 22nd. And this is showing where equity is 63% and fixed income is 28%. So it's a moderate growth portfolio. It's not aggressive. This amount does not include the real estate fund or the private infrastructure fund that Burgess houses, I think, at SEI. So there would be a little money otherwise there. So the next page over, page 8, is a list of the mutual funds that we use. It's very simple, very low fee funds. It's almost a long-term strategic portfolio. And it's very simple, easy to understand. Any questions?
Any questions?
Sorry, I'm late. I had a conflict at 12 and I found out a little bit late in the game that this is rescheduled to 12. I asked this question to Dwayne at the fire meeting, and the question is there anything that he would recommend that we add to the program here to enhance the performance?
And I said at the other meeting that hire an active high yield bond manager because they usually beat the benchmark historically. So right now, your high yield bonds are in an index fund. You own all of them, the good and the bad. An active manager would find the best high yield bonds. And I've noticed that most of these managers do that. So I would add some money to an active manager and see how they do.
Thank you.
Do you have any thoughts on that?
I guess the thought that I would have, a question I would ask, registered, when the answer came, did you have an opinion one way or another about it? But also, if you had a positive opinion, did you have a bond manager in
In
sight? Yeah.
in mind.
Mhm.
When I asked the question, I didn't know what he would say. We didn't talk about it before the meeting. I wanted him to see what his immediate reaction would be. I like high yield. In fact, when we get into my report, you'll see that high yield has been a nice performer for you. But you have participated in the index as opposed to having an active manager. So you know the difference. You hire a firm, they pick the individual bonds, pay them a fee for that. This is third and it's paid a fee to pick high quality bonds. There's a difference in the coupon, higher coupon, higher yield. That's why the performance varies. And Dwayne's position is there are some active high yield bond managers out there that we should take a look at. And I think it's a good idea. We should do that.
Okay, I guess we're looking for some direction on how to approach that.
Well, Anna's on the phone. I don't think you need a motion. I think administratively, we're going to work on something and at the next meeting, present some ideas, recommendations.
Is that acceptable?
Okay?
Yeah.
Thank you.
Okay, after you approve his report, I want to ask a question, Laird, and sorry I'm late, so I'll wait for the board.
Okay, do we have a motion to approve the presented? All in favor? Aye. Thank you. Go ahead.
Thank you. Let me first open up by saying that you have really some heavy hitters here. You have a portfolio manager from Tallahassee, you have a portfolio manager from Jacksonville Beach. Close enough?
Close enough.
Where is it?
On Meter Beach now.
I'm sorry. And Leardon is both an expert in fixed income and equity, so it's really nice that he could make the trip down here. I think previously, Greg was coming down here and,
We had a client service. person.
yeah, and to get someone really who works in the back and runs the numbers and makes the big decisions to come. I hope, I don't know how long you're gonna keep doing this, but, it's a refresher to have you guys, both of you guys come to these meetings. You know, looking back at the COVID period. But I wanted to ask you, Leardon, about we talked about earlier this morning about the economy. Two things, a couple things. How do you think raising the debt ceiling is going to affect the economy and the bond market? And we talked about the M2 money supply, not to get too complicated, but you may want to give them some background on that, how it expanded, why it expanded, how it's contracting, how the Fed is engineering that, and how that is having an effect on slowing down the economy, because I assume that you made some observations earlier that the economy is slowing. And generally, the bond guys are very intelligent about the economy. Equity guys tend to be more optimistic about the economy. The bond guys tend to be more pessimistic. Is that a true statement?
Sort of, yeah. I mean, we're a little bit more focused on risk management part of the equation.
Can you come up here and address those questions, please?
Sure, absolutely. I guess I'll address the second question first. You know, as you know, the M2 is the big topic. The fact that the Federal Reserve took drastic measures post-COVID because we didn't know at the time where are we heading, where is the economy heading. The fiscal policy, the government was trying to do the best it could at the time. In hindsight, it turns out that we kind of overdid it in terms of stimulating the economy. But the fact, what happened back then was this merger between fiscal policy and monetary policy. Fiscal policy issued trillions of dollars of new debt, and it was all monetized by the central bank. And that new monetization caused the money supply to explode. The money supply is a simple measure that gauges the overall level of money supply is the M2 that Burgess addressed. You look at what is comprised of M2. M2 is essentially it's the oil of our economy. It's the total bank obligations. You've got cash, which is a unit of account, medium of exchange, and you have money market funds. So if you aggregate all that pools of liquidity, and you look at that money over time, it turns out that we increased the money supply by an incredible amount in the last couple of years, 2021, 2022. And what has happened since then, since the Fed reversed course and started hiking rates, started reducing the overall liquidity in the system, started implementing what's called a quantitative tightening, essentially reversing the balance sheet expansion. Part of that objective was to reduce the money supply, reduce the M2 level. And what's been happening in the last year is actually M2 has actually been declining, which is the first in history. Usually it decreases, but not at a negative rate. This time it's actually going negative, so meaning the money supply is shrinking. So when you have a money supply, when you have a liquidity that keeps shrinking, couple that with some of the leading indicators, as I mentioned to you earlier, that are pointing to the economy slowing down, such as manufacturing data, ISM orders, that could be a recipe for some potential volatility in the near term. So that's kind of what's happening right now. The Fed wants to shrink all that excess liquidity back and try to get the economy back to being balanced, being in that equilibrium, if you will. The second question that Burgess asked was the fact that debt ceiling had a sort of a big effect in our markets, in the fixed income markets, and I would argue in the equity markets as well. With the Congress passing the debt ceiling limits, in other words, they gave the government a blank check. There's an unlimited spending for the next couple of years. What's going to happen is for the next 6 months, the Treasury is looking to fund at least $1 trillion worth of new supply to its TGA, the Treasury General Account. That is the major account that is used for discretionary spending. And what's going to happen is that you're going to have this huge amount of new supply that will hit the market. But what I addressed in the previous meeting was that most likely the Treasury will be a bit more tactical in terms of how they're gonna hit the supply. They're gonna probably most likely focus on that shorter part maturity, that 3 to 6 months, where they can target the money market funds, they can target the T-bills, and the overall side net effect of that will be sort of a muted reaction from a Treasury standpoint, from a rate standpoint. They're not going to affect too much the longer term maturities. It's going to be more of a front end stuff. The other potential result of that could be the fact that, you know, I would argue, heading into the debt ceiling debates, because the TGA account was drawn close to zero, that had an effect, a stimulative effect into risk assets. In other words, think of it, you know, the government wasn't taking cash from the economy, it was actually keeping the cash into the economy and had a decent effect into risk assets. So reversing that, meaning increasing the TGA account, has the opposite side of it, right? So it's going to withdraw the liquidity from the risk assets. So arguably, you could say it might have a slight effect in the bond market, but maybe a slightly bigger effect in risk assets in the near term. So that's kind of.
Now, there's something else that's very bizarre. It's kind of hard to follow all this back and forth with money. But how big is the Treasury balance sheet now? I mean, the Fed's balance.
Fed's balance sheet peaked at 9 trillion. Now it's come down to about 8.7 trillion.
Not too far from where it peaked. So the Fed owns a lot of bonds. And those bonds that they collected during the period of quantitative stimulation. When those bonds come due, that means people who have to pay the Fed back the money. These hundreds of millions, billions that come back to the Fed. What do you think the Fed is doing with that money, that cash? This is illogical. The answer. Tell them.
It kills it.
They're burning the money. They're destroying it.
So that's the shrinking of the liquidity.
It's crazy. On one hand, they're issuing bonds to the Treasury is to raise money for the spending needs of the country. On the other hand, the Fed, which is supposed to be an independent entity, has its own game that it's playing, trying to steer the economy to a point where it maintains full employment, which is the primary role of the Fed, not fighting inflation. They're not very good at that. That's not really what they were designed to do, and I don't think anyone's very good at it. But to think that they can just take billions of dollars and just put it into a grinder, it's just mind-boggling, but we heard it here today. That's exactly what they're doing with the money.
You almost have,
Palatka could use a little bit of that money.
Maybe, yeah, I think so.
which that's what gives us a little bit more confidence in terms of the inflation normalizing because of these effects that we're addressing.
That's it. Thank you.
Thank you, Louis, Mario, appreciate it. BCA report, or just?
Thank you. If I could, I just wanted to go over briefly, you know, our role here is not just to generate discussion, but we've developed a model portfolio, model asset allocation, which Dwayne has done a great job in carrying out. And there's a page in here I want to show you, which illustrates how the model works. If you go to page 17. So we have a handful of tools that we work with. One set of tools are asset classes that are equity alike. These are stock-based funds that are designed to grow at somewhere around anywhere between 8, 9, 10, 11% per year, depending whether they're growth stocks or value stocks, how much they pay in dividends. Then on the other extreme, there are bonds in the portfolio, which are designed as a liquidity bucket. They're designed to, that's primarily what the bonds are there for. And it just so happens that the bonds generally don't do very well when stocks do well. But when we have a big crash like we did 2008, 9, the bonds actually did well because people poured their money into bonds. And we rebalanced beginning in May of 2009. And that's worked out nicely for you guys. What happened last year, though, was bonds didn't rally. Bonds fell at the same time stocks did. This is a very rare event. But if you go to page 17, you can see that with the model, the strategic model for the last 5 years was essentially achieved by the total fund. The two dots are superimposed. The risky stuff is on the east side here. Those are the equities, and the fixed income is on the left side. That's the plus sign. But while we're here, we'll look at page 18, which is going back to 2005, a history of how the retirement plan is performed. You can see the disastrous results in 2008. I should mention that that's fiscal 2008. Then that means 2008, September 30. The next 2 quarters were also bad. So the first half of fiscal year 2009 was horrible. But the last half, there was a huge rally. So in your case, your fiscal year return was about 0.6%, but there's a huge gains on the second half of the fiscal year that brought it back to essentially zero. On to the left side here, 2022, you can see a worse experience, and really it's because bonds and stocks both fell tremendously at the same time. Now, 9.8% is a pretty good return for the first 2 quarters of the new fiscal year, and I would venture to say you're probably up around 11% so far in the new fiscal year. The last meeting I couldn't attend. Mitchell Brennan, did he do a good job? Yes, he did. He's a good man, isn't he? I have clients where I've sent him to, help me out, and then I show up the next meeting and they say, "What are you doing?"
I was surprised to see you here just to get him.
Hey, but he was captain of the baseball team at Stetson, not too far away from here. And anybody who's a team captain in baseball, if I could get him to work for me, that's quite an accomplishment. And he's a great kid, smart. But on page 16, I wanted to show you this because you can see the couple interesting graphs here. First of all, the green graph is a downward slope, and what that means is that the plans continues to spend money. You go to page 7, that kind of ties into the green line on page 16. The flows of the plan for the last 10 years on the right-hand side were minus $4 million. This plan gets money from the city, payroll, money's taken out of the officer's payroll, and then the Chapter 185 money also comes in. You have 3 sources of money. Then the reverse of that are the expenses primarily for retirees. So the net flow for the last 10 years was $4 million outflow. You look at the last 12-month period, it was about 469,000. Now, just kind of easy math in the head here. It's on an annual basis, it's a little 4 million over 10 years is about 4 million a year. Last year is about 469,000. So it's similar compared to the 10-year average. And the good news is over the last 10 years, the plan earned 1.5 times what it paid out. So you earned 6.8 million, spent 4 million net. See that? So that's why that green line has a negative slope to it on back to 16, because the flows in the plan are on an average basis are negative. The only way you could make it positive would be if you put more money in, or if there was less money going out, but it's always going to be negative. Fortunately, the plan is earning enough money to sustain that. Now, the blue line here represents the market value of the plan.
you'll notice it at when the pandemic was really racing, by March of 2020, that's when the blue line dipped down to 10 million. And then with all of this actions by the Federal Reserve and by Congress during the pandemic period to keep the economy from rolling over, that's where we saw this huge rebound and expansion of the value of the pension valuation. You can see at the peak was over 14 million by December of 2021. Fed announced after that, Jay Powell announced party's over, we're going to start raising rates. Now we've seen 10 increases or 11, 10, 11. We've seen 11 increases. And now the Fed funds rate has gone from 0 to 5.5%. Interestingly enough, the last 2 quarters, we've seen a rally in the stock market and to some extent the bond market. So there is the sentiment out there is that, and I want these guys to opine on this, but the sentiment is we are probably very close to the end of Fed tightening.
I would agree with that. We think that that's
What do you think?
next meeting will be a pause and then we'll start a long pause.
Okay.
I think we're done. In summary, I'll skip the banking piece on page 1. I'm sure you've already heard a lot about that. But on page 4, everything rolled together. Everything rolled together. I'm on page 4 now. 485,000 was earned, 4.3%. Respectable ranking, nice rebound international. We have 2 international pieces here. And Vanguard Institutional Index, which is large cap. So large cap and foreign stocks really came back nicely. Fiscal year to date, Dwayne's probably already mentioned this, up 1.1 million or about 10%. You're probably up about 11.2, something like that, fiscal year to date through yesterday. 3-year average is respectable. I like it, 10.2%, 3.4 million. And that's in the wake of last year's collapse. You saw that graph, that blue graph. So you captured a lot of that in that 3-year, it's all in that 3-year number. 5-year average, 5.8 net. Florida retirement system has lowered their expected return now, 6.7%. Is Ann on the phone?
Yes, I'm here.
Is it 6.7 or is it 6.6?
I think it's 6.7, but I would want to double check.
We'll double check for you, but they're moving it down and this has been ongoing, but my guess is they're headed towards 6%. They may get there next year, but they definitely have telegraphed around the state that their intent is to continue to bring down their assumed rate of return. And I should add that they don't have, their investment policy is much more unconstrained than ours is. They can do things that we can't do. On to page 8, I think,
Before you go there, question for you.
Yes.
Without investment policy being where it is, does that put us, does it leave us in a, I guess, a very conservative position?
I would say, I probably shouldn't say this. I would say your money is, their problem is they have way too much money to manage. And they have to figure out where to put it. And so they have to find buckets that are big enough for their money. And we're small and nimble. And we can change the play up at the last minute before the ball is hiked. They can't do that. And if they have a $150 million building they want to buy in Denver, they'll buy it. Because they got to get that money out. Paint hadn't even dried yet. Might be 1/10 in that building. But we would never do something like that here. So we, in a way, even though they're unconstrained,
they are at a great disadvantage because they have way, way too much money. They may get a call from, these are things they've done. An insurance company that owns a pecan or an orange grove in California or an almond grove in California, and the insurance company has to sell it because they need money. No one wants to buy it. It's a $300 million investment. No one wants to buy it. Who's going to buy that? But these big state plans have the money to buy those kinds of things, or maybe a real estate project in outside of Scottsdale. This is a hypothetical that went bust in 09, 010, 2010. Nobody wants it. It's big, it's complicated with the banks and foreclosures and lawsuits. Who's going to buy it? So these big pension systems are kind of, they're in that business. We don't do that kind of stuff. Get the picture?
So we're in a new position.
I think you're better. I think we have a much easier time. In all fairness to the folks in Tallahassee, I think we have an easier time managing this pension plan than they do. They're very challenged. I think they do a good job. But I think on page 8, Dwayne probably already mentioned this. Yeah, we have a site underway to domestic equity and a site underway to international. Site underway to private real estate. Private real estate is going through a period of compression right now as interest rates have risen and cap rates have gone up, and naturally real estate valuations have had to go down. That will correct over time. The global fixed income, we have a 3.5% overweight. Dwayne, I know, talked about that earlier. He's comfortable with that, and I am too. I'll just show you a couple of things that might be interesting for you. On page 11, under the FYTD fiscal year to date column at the bottom there, international at 25.8%, 6 months. So there's that international rebound. You may remember the last meeting that we talked about the fact that international had trailed U.S. large cap stocks for 14 consecutive years. And we have some clients that said, well, why went international? But as we drilled down deeper, we realized that international was selling a year ago at half the price to earnings ratio of the S&P 500, which you're invested in, S&P 500. And twice the dividend yield was the S&P 500. It was cheap, dirt cheap. Why was it so cheap? What's happened? Well, what Dwayne, I think, explained to you was that it's the technology component in our country, in our economy, that's been the big driver in this outperformance for so many years. And that's why international got so cheap, because it didn't participate in the growth area, the technology area, like the US. Appears to be a reversion in place right now. Second thing I want to mention to you on page 12, high yield. The 3 million you have in fixed income, 2.3 with Sawgrass, and this shows 706,000 rounded with high yield in the index. But you go back during these past periods, high yield has outperformed high quality on a 5-year basis, 3-year basis, all these different time periods, except the most recent quarter. Fiscal year to date, 8.3 versus 5.5. That's not a reflection of Sawgrass. They're doing what they're supposed to do. They're managing money in a very limited, high quality space. Do you want to comment on that?
Yeah, but the main driver of that hasn't been.
Just wait. And this is kind of an academic response. Go ahead.
Yeah, it's true that high yields up, low quality is outperforming high quality in general. But the main driver of that has been not the spread part of that, but it's been the duration part, the interest rate component of that. The higher quality asset class in general, it's much longer in terms of the maturity, interest rate sensitivity. And because of this big increase in rates that the Fed was instrumental of in terms of driving rates higher, the higher quality, which is kind of reverse, right? Higher quality did underperform lower quality because of the duration.
Do you have an interest rate chart in your book?
I do.
history?
I think I do, yes. Page,
You still have this book?
Yeah.
When should I tell?
you got two, as a matter of fact, one, the front end, it's on page 10. That is the chart that tracks the 2-year treasury rates with the Fed funds rates. You can see here the dramatic increase in the last 2 years. So we went from 0 for a period of time post COVID, all the way up to 500 basis points in the Fed funds rates. And this is just a 2-year chart, but you can also see,
So let's stay on page 10 for a second.
yeah,
What, the reason why we liked high yield, have liked it, is because when you have periods of declining interest rates, companies that have, call it weaker balance sheets or not as strong, get stronger because they're getting these hormone shots. They're getting, there's cheaper money in the marketplace. They're able to survive. So high yield has got a nice tailwind from Fed policy of loosening or lowering interest rates. Now, the reverse is in place. Now, the so-called zombie companies that have stayed in business all these years with low interest rates, who are classified as junk or high or low quality bonds, are now facing a higher potential of defaults. What has been the default experience lately?
it's starting to perk up. It used to be in low 2s, which was a record in historically speaking. The historical default rates ranges anywhere from 3 to 8% based on where we are in the cycle. But to Burgess's point, a lot of these so-called high yield companies, they rely on the market, because what they normally do is when the debt comes due in terms of maturing it, they don't have the funds to pay it off. So what they do is they come back to market and refinance, they roll it for the next 5 years. So the cost of funds and the overall liquidity, whether are they going to be able to come back to the market, meaning is the market going to fund them this new debt? Those are functions of the market that could potentially cause trouble for that company.
I mean, you'd be surprised that companies are in the high yield index, airlines, communication companies. They just don't have a bond rating of A or better. And I would imagine that most of your stuff is government and agency mortgages, stuff like that, and
they're all AAA or
AAA.
credit wise is A rated or higher.
but there are a lot of companies that have fallen out of the investment grade status, and there are an increasing number of companies that are called junk because they're not in investment grade. But the other reason for this was this gives you a fuller participation in the bond market, and it's about a quarter of the allocation of fixed income, and that's why we recommend that you maintain it.
You get that extra spread that works over time to Burgess.
Yes. That's all I have
Thank you.
today.
Anybody have any questions?
I have one question, Rick.
Yes, sir.
We know, I guess, I heard on the news that it's going to be somewhat of a recession toward the end of this year, maybe going into next year as well. How do you see that? What do you see coming out of that?
Great question. I should mention before I answer it that all the experts were calling for recession a year ago. They said that we'd be hitting the recession sometime towards the end of last year and coming in this year. The reality is the economy is huge, big, we're the biggest in the world. I think Laird and already talked about some cracks that are already showing up. You can see it retail, trucking, shipping. FedEx and UPS have already announced that their volume, shipping volume has decreased. But there are other areas of the economy that are very strong. Leisure, hotels are just rocking. BlackRock just sold Marriott. Make a lot of money on that. So it's not going to all happen uniformly. It's going to happen in pockets. The office market is hurt.
downtown San Francisco, downtown LA, downtown Portland, those little microcosms are being hurt by the absence of people going to work, still working from home. And New York City, you've been to New York City lately? The restaurants, all those great restaurants are gone. Now, I don't know if they're ever gonna come back. But Boston's different. It's a great town. Cleaner, safer, lots of restaurants, vibrant economy, a lot of biotech, a lot of universities there. It's a whole different environment. But what I want to show you on page 8 to answer your question is over time, since I've been privileged to serve you here, we've had these two major buckets. We've had the fixed income bucket and the equity bucket. And as I illustrated in 2009, when the market bottomed out in March, we waited for the smoke to clear, and in May, we said, let's get back into stocks. Now, back then, the bonds had made a huge run up, had appreciated, and the stocks were still way down, so we started moving the bonds. So it doesn't really matter when these downturns occur. We just know what to do when they happen. Now that it appears that the Fed is likely to start easing, perhaps at the end of this year or into next year, you'll see bond values go up. Equities may roll off again. And if that happens, we will rebalance, start buying back into stocks again. I don't think anybody can predict what's going to happen. Timing is impossible, and the Fed is very difficult to judge.
When they put out those reports and whatnot, it affects the market, you know. You mentioned, we could actually just mention inflation, and mention a recession. It affects the market. And they have already, in fact, we just started talking about it this week. Recession, could be going into a mild recession, as they say.
Well, you know, you can take little slices of our society. People in Florida, there are a lot of people in Florida whose wealth on paper is going through the roof. There's a continual migration of people from the West Coast into the Sun Belt and into Florida, as you know. Prices of homes all over the place, and it's even happening here. I never thought of it. I was thinking, it'll never happen in Palatka. It's happening in Palatka, Jacksonville, Orlando, Miami. It's going crazy. Coral Gables, values houses in Coral Gables have gone up threefold in the last 4 years. What's going on here? So people have a sense of wealth that they didn't have 5 years ago. And what are they doing? They're spending it. They're going on cruises. They're buying stuff they couldn't buy during the COVID. So it may be that the recession is not as severe in the grand scheme of things. It depends on where you live. You want to see a depressed area? Go to Gary, Indiana. Lots of places in Ohio that are beaten up. Upstate New York, Mississippi, tons of areas that are beaten up. They may never come back. But meanwhile, there are lots of places in the U.S. that are prospering during this conversion. Want to add anything?
I mean, you know, US in general is a service-based economy, and services by nature, by definition, you know, healthcare, education, they're not as cyclical, right? So you get that smooth ride with the services. The biggest volatility that you see and the headlines that they're focusing on is on the manufacturing side, the goods. On that part of the economy, yes, I do agree with you that there's recession. We might be already in a recession, but that's a much smaller part of the economy. So net, it balances out that you get this kind of a smoother ride, if you will.
So on the manufacturing front, Hyundai is building an EV plant in Savannah. LG is building a battery factory in Savannah. LG. And then the other suppliers that Hyundai relies upon to build these cars are all coming into that area, west of 95. And it dawned on me the other day, driving back from Savannah, why did they pick Savannah? It's not just because of the river.
Not just because of that, it's because a car factory needs reliable, cheap energy. And we have more and more energy that's becoming less reliable. The sustainable energy supplies, you get a cold weather, the wind turbines stop and they freeze, or you can't, or the pipelines that move the gas stop because the compressor station shut down. Nuclear power. The Savannah just started up their second nuclear power plant. So Conde goes to Georgia Power and gets a 15-year deal with Georgia Power. They get all the electricity they need to run that plant. That's why they're there. And so there is a shifting of suppliers and logistics and manufacturers coming into the United States. So why you have companies that are dying on the vine. By the way, Mississippi, which is a struggling state, a state which I have I really like Mississippi, like the people there. Another battery plant, large battery companies coming in Mississippi to build a facility. But so these companies die off, new ones come in. And so we have all this dynamics going. We may not have such a bad recession. Long answer, hopefully it helps you.
Any
All
other
right.
questions?
Thank you.
Thank you. Do we have a motion to approve the report as presented?
Motion to approve the BCA report is presented.
Second.
All in favor?
Aye.
Aye. Thank you.
You're welcome.
On to Placer, Kaufman, Jensen, Levinson. Parish.
Hello. Okay, so first, can everybody hear me okay?
Yes.
Okay, great. The first thing that we can discuss is the subscription service for death checks. Jill, stop me if you don't think this is necessary. I did speak to Lindsay, regarding the previous meeting, but essentially I had a conversation with the representative from the company that performs, among other things, it's called Certa Death. The minimum invoice for any plan is for 0 to 500 participants. So, it was our suggestion that the 3 Palatka plans would join together. Looking at the last valuations, there were approximately 372 individuals that would cover. It would also give you room, shifting a little the numbers in each plan, you're not going to get close to that 500 mark. Sorry, did you say something?
No, sorry, go on.
Oh, okay. So the invoice would be $3,500 per month. That would be split between the plans. Once the individuals were put into the system, they could be separated into separate groups that Jill could see on, a quote unquote dashboard that she would have access to. The reports would be run every Monday. You would get a response by Friday that would say, no match has been found for these participants, or a match has been found. And in that case, the source of that information there would be included. So if there was, a newspaper article or something from Social Security, anything like that, you would get a link specific to that information. All of this is double checked by a person, not a computer. They stand by their product and their work. That being said, I think it only makes sense to move forward if all of the plans are going to participate, just because the cost, is up there. So split 3 ways, I think it's doable. But I'll leave that up to you all.
Okay, what are our thoughts on
recommendation is to move forward and to share all of the plans. And let me ask the plan administrator, what do you see the approach being?
Well, the fire department delayed, tabled their vote because they didn't think it was worth it, given that really they have 14 retirees, and then all their active employees as well, I keep track of. But, the police department has about 28 retirees. I think this is $42,000 that the plans do not have to do. We just don't have the volume of deaths that would make this an issue. The police department may have one death a year, may, some years none. This was all a part of that fraud case that happened down in South Florida, where they got away with $3 million because they weren't doing death checks. But we have a process in place where I do a live and well every July and follow up on the retirees to be sure that they get their return letter to me that's been notarized, so I know they're alive and well. I think we'd never recoup those costs.
Jill, can you remind me if the custodian does checks?
When checks are required, I get information from who, like the invoice, or
Mm-hmm.
somebody who is leaving the plan and needs a contribution refund. I get that information. I present it to a second signer here, who is
Okay.
the interim city manager. He has to sign off on it. And then the information goes to the pension banks for them to cut the checks.
And does that custodian bank, do they do their own death checks? I know sometimes they do.
Yes, they do. They have their own death checks as well.
Okay. Yeah, I mean, I think it only makes sense if it's split because it is a significant cost. And, you don't have such a high volume. So, I could see, moving forward either way. I don't disagree with you, but, more protection is never a bad thing, but, you have to weigh the pros and cons, as well as the financial aspect. So I'm okay with that decision.
Do you normally get that information back pretty time and know the rights and all?
Yeah, they go out in July. Most everyone has it back to me by the beginning of September. Most. Those who do not, I follow up with a certified mail letter to them. And if I don't get it back, the letter was written by the pension attorney, and it has threats that we can discontinue their payments until I'm contacted. I haven't done that. Generally, people do eventually get a hold of me for some reason.
Typically, once that letter goes out, that payment is going to be stopped. People are, a little quicker to respond.
So you get about what percentage?
Oh, I get about 90%. Yeah. Yeah.
Okay. All that said, do we just want to table this? Do we want to say no thank you? How do we want to proceed?
I think, one, we don't have that very many. That's my opinion. We don't have very many. And I think it's feasible for us to do it, especially when the other hands seem like they're not in favor of doing it because they don't have that many. So.
And that makes sense. I think that's probably all of our view with this information presented. It doesn't, the number of folks do not warrant its cost.
Jill, did the other boards just table it, or did they?
The fire board tabled it. They were opposed to it, but they didn't take a vote on it. They just tabled it to see what the other plans were thinking. Really, the biggest plan, of course, is the general, and there we have like 140, so retirees. But even at that, there aren't that many deaths in any one year.
I personally think if the fire department was against it and only tabled it, see what somebody else was doing, that we would go ahead and say no. That way they can revisit it and they can say no at that time too. Leave it up to the general board whether they want to feed the whole $335 or the $3,500 bill and just take themselves on.
But general has not met yet. correct?
Not yet, not till 2.
But at least that also gives general a view of what they're looking at.
Yeah, for costs.
For costs, yeah.
And Jeff, I move that we do not enter into a contract agreement with this, certain debt proposal.
I second.
Yeah.
Very motion is second, all in favor? Any opposition? Thank you.
Okay, thank you all for that. Lastly, I just wanted to touch on some of the highlights of House Bill 3 that is going to take effect July 1 of this year. Our issues are focused primarily on prohibitions on environmental, social, and governance, which they're referring to as ESG, targeted investment practices. Basically, investments cannot be made on non-monetary considerations. You cannot make an investment based on a social, political, or ideological position of the company. I feel pretty confident in saying your investment managers are likely not doing that right now. I'm sure Burgess could speak to that. I think monetary considerations are and will always be number one. But with that being said, if you were looking at an investment manager was looking at, an oil company, it wouldn't be appropriate for them to say, well, oil is bad for the environment. As a result, we're not going to invest. If it was a bad investment because, the returns weren't promising, that would be fine. But in terms of, environmental, political, social stances, that wouldn't be appropriate moving forward. Proxies must also be voted this way, so based purely on monetary considerations. A detailed report regarding proxy voting will be required by the end of the year. There will be more guidance coming from the Division of Retirement on that report. So, we will keep you updated on that. Additionally, there's some new language that has to be added into any new investment manager agreements. That's something that we would handle on our end. Nothing major. Like I said, I feel confident that this won't have any impact on you. But, it is something that's being talked about a lot right now. And so we wanted to keep everybody informed.
Thank you. Any questions? Thank you.
Thank you.
Do we have a motion to accept the report as presented?
I motion that we accept the report as presented.
Second.
All in favor? Aye. Any opposition? Thank you. Moving on to FY24 budget.
So this is the budget for the upcoming year. Changes are the investment fees from ARA. That's the new real estate investment that we started in October. Off the budget are any investment fees from SEI, Cohen & Steers, because we've gone into their product rather than individual, so there are no investment fees. So they've kind of swapped out. Higher Foster & Foster invoices expected with their new terms that they presented us in the fall, their new rates. But otherwise, just about everything similar.
Do we have any questions?
I guess one question I do have, you guys have seen like you have selected what conferences the board members, trustees could go to. Have you, I see an estimated proposal here of $3,300. Is that for the one in Orlando?
That's for any of the conferences you want to go to. It's just 3 trustees going to one conference, whatever conference you want to go to. There's usually about 2 a year. One hosted by the Division of Retirement and one,
FPP.
yes.
I just want to make sure that, you know, we have a, you know, I mean. when I
You
look at
have
3,000
choices.
Okay, when I look at 3,000, not that I want to go to a conference right now, I'm just too busy to be doing so. But I want to make sure we have enough in the budget to make sure it covers the cost.
And may I make a suggestion, because this has come up with other clients that we have. In fact, Stu Kaufman from Anna's firm and I have done a joint education for our clients and at no extra charge. So we could do that here. We could just set it up. Whatever, maybe the boards could all come in jointly and do it, all be in the, and we could do it on a number of topics. Our esteemed advisors, I'm sure they would be happy to participate if they'd like, so we can cover a number of topics, but we can cover the requirement for education independently at no cost to the city.
I'm in favor, but I think we probably need to take the consensus, get the consensus of all the other pension boards.
Yeah.
You can invite them.
Personally,
Yeah. That's
personally,
right.
I'm
I
in
think it's
favor.
too, because we all, it is challenging to attend something among other things.
Right.
So I would be, yeah, it would be a great opportunity. I think.
I have an idea. If you guys, if you wanted to go ahead and try to set up a date, then the other boards could be invited. I don't think it's something that, it's no cost. They don't have to vote on it.
How long will the training take? What's
It really depends on how much, how one can tolerate us. I would say an hour.
Okay, cool. Good.
Yeah, I think an hour seems reasonable. You start to lose people if you go much further than that. They get that glazed look.
Yeah, I know. I mean, I've placed a lot of people. But we can come up with some interesting topics and make it, and there's usually a legal piece too. So Anna could talk about the sunshine, I don't know, whatever she wants to talk about, sunshine law.
Will this cover the regulatory requirement for training?
I would let Anna answer that, but are you still there, Anna?
Yes, I'm here.
The question is, if we held a workshop, education workshop here in Palatka, would that satisfy any regulatory requirements that may be out there?
So I believe it should. I'm not sure if there's an actual numerical component to it, that it has to be so long. So that's something I could certainly double check, but I don't see why not.
Okay. Were you able to hear the conversation we had about? So
Yes, just keep us, in the loop on dates, and we'll see what we can put together.
Okay, thank you. There you go.
Thank you. Anything else in regards to the budget? Make a motion to accept the budget as presented.
So we accept the budget as presented.
Okay.
All in favor? Aye. Any opposition? Thank you. Quarterly expenditure.
Nothing really surprising in this. In bold are the employees who've chosen to take their contribution refunds because they weren't vested. Otherwise, it's normal pension payments and expenses from the different investment.
Move we pay the invoice.
Motion.
Second.
All in favor?
Aye.
Aye. Any opposition? Thank you. I'm going to open the floor to public comments. Is there anybody here for public comments?
No.
Seeing none. I can see this.
you wanted to address your concerns.
That's okay. One of the things that I'm concerned about is getting the, I guess, material that we need to look at prior to, meeting timing. And I know that, I did not get mine.
Did you get any of them?
I got some through an email, and that's not the best method when I go in and look at my email and all of them jammed all
Yeah,
together.
this has happened before. This has been a challenge before.
Well,
How can we do
they're
that?
getting it a week in advance, and you're getting it as individual documents on an email. So you might get 8, well, how many do I have here? 8, 9, 10 documents on one email.
Maybe, can you break it up?
Well, they're separate documents. If I give you they're attachments to one email. If I give you an email for every document, it's gonna take me and it's gonna
Why
be
why
confusing to you.
are we not getting the books like we used to? We used to get books timely and.
He's talking about 2 weeks in advance.
We want to make you happy. What do we need to do? Get the books 2 weeks in advance?
If that's not feasible, we can compromise, for sure.
But I want to know if it's feasible. That's my question is it feasible to get?
If you give us a date, when you actually have to have this stuff. Well, we have to design the schedule, or just put it into the schedule. So.
I will
just
say,
need to know.
if your problem is printing them all out, I have the other board that they come and pick them up from me in advance. I print them out in advance, but a week in advance. Because if I print them out, well, I only get them a week in advance, but as soon as I get them, I print out copies for them. They come and pick them up.
I guess my concern is my issue is you're gonna still have duplicates.
Oh, yeah.
And the reason, and I'm saying you're gonna have a printed one to print out, and then you're gonna have the actual books once you get here and whatnot.
We can get them to you 2 weeks early.
Okay,
Yeah, well, we have no problem producing books, so.
all right.
You need to let my office know. Kristen. No, I mean, I made a note here, if you would just email her, please, between the two of us, we can get that fixed on
Okay.
our end.
And it should be a problem for me at least to come by and pick it up.
Same thing with Lori.
All right.
Yeah, we certainly don't want you mailing it.
Right,
I'm just-
just email and just let us know that the books are available to pick up.
Sure.
Lean on her and she'll lean on me. How's that sound?
I tried to leave on earlier, but she pointed me to you guys.
Wise woman.
All right.
Okay, any other business?
The next meeting is August 29th. And it will be at the normal time.
What's normal?
Normal is 1:30.
August 9,
Yeah, August 29
excuse me.
at 1:30.
Normal.
Okay, do we have a motion to adjourn?
Adjourn.
Thank you all.
Thanks, everybody.
Started.
Okay, I've unmuted.
So Jill, do I need to read the call or do I just call the meeting?
Call the meeting to order and I'll
Okay,
read the roll.
so we'll call the general employees retirement and pension meeting to order. Roll call,
Jonathan Griffith,
present.
Brett Dennis,
Here.
Alan Bush,
Here.
Tammy McCaskill.
Here.
Thank you. We have a quorum.
All right, first item on the agenda is the approval of Brett Dennis as chairperson pro tem.
So move.
Got a motion, is there a second? Second. Any discussion? Seeing none, all in favor say aye. 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 Ms. McCaskill?
Aye.
Okay, passed. Approval of minutes. Has everybody had a chance to review the minutes from the past meeting on February 28th?
Yes. I'll make a motion that we approve.
Okay, there's a motion. Is there a second? Second. Any further discussion? Seeing none, all in favor say aye. Aye.
Aye.
Opposed? Thank you. All right, that brings us to item number 4, Foster and Foster.
I do not see him on the call yet. Maybe
Okay,
we
well, we
should.
could move on and come back.
Yeah,
Are you prepared to give your report?
Sure.
Okay.
Okay. Everybody have it in front of them? We have some extras. Good afternoon.
Good afternoon.
Well, it seems like every year there's something else crazy going on, so. Let's kind of get a backdrop of the discussion here. And you can start on page 1. You all have followed this. And I'm sure you're aware that the banks, especially on the West Coast, any banks with a heavy tilt towards lending in the venture space, these are small startup type companies, have been under a lot of pressure with people pulling their deposits out. And the Silicon Valley bank run was, I think, surprised a lot of people. That bank, 55% of the loans that were made out to these small venture startups came out of this bank. And this is how it would work. You'd literally go to that bank with some mousetrap, new idea, and they would lend you the money. You need 15 million, it's 15 million. You pretty much loaned to anybody. But they wanted you to keep that money at their bank. And then you would burn that money as you try to start up the business. But the trick was they had, they tended to have warrants in these companies that they invested in.
sorry, I'm trying to get a hold of Patrick.
It's all right. So they would offset that risk by owning warrants. So 1 in 10 of these companies that they were lending money to, they probably weren't going to be able to pay the money back. But if 1 in 10 really hit it big, those warrants, which became a stock that they could later sell for cash, made up the risk. That has all come to an end. So the banking system now is being re-evaluated. You probably read that the Fed is now moving towards very quickly imposing higher capital requirements among these banks, even the big banks. So the regional banks still are under pressure because they aren't paying enough on the deposits. You can get 5.5% on a 9-month U.S. Treasury. You can't get 5.5% at the bank. You might be able to buy a CD, a 9-month CD, and get 4. So the larger companies are a safer bet right now than small companies. Larger companies that have good solid balance sheets are a better bet than companies that have weak balance sheets. Companies that have pricing power, big companies like Microsoft that have pricing power, they can raise their prices, or Apple, those are better bets than companies that that don't have that kind of leverage in their space. The economy is slowing. You can see it in trucking business is down, trucking traffic is down. That's already been reported by UPS and FedEx. Manufacturing is down, even though manufacturing represents a small amount of the U.S. economy, we're primarily a service economy. There is an amplification of about 6 times. So, industrial jobs, manufacturing jobs have 6 times the impact of service jobs to the economy, but service jobs overall are a much bigger part of the U.S. economy. We've had 2 good quarters. I'll go to the summary piece first here on page 4. We had a decent fourth quarter, which is your first fiscal year quarter. You earned $665,000 during the first quarter. When you combine the first quarter and the most recent, the fourth quarter last year, the plan had earned $1.6 million or 8.8%. The market has since moved up, and you're probably closer to 9.5 to 10% as we speak. So that's not a bad place to be, given we have plenty of time left to finish out the fiscal year. Raising the debt ceiling essentially gives Congress a blank check for a number of years, so they're not going to go back and play chicken again next year or the year after. So that took a lot of pressure off the market. Frankly, as the Congress spends more and more money, it just simply means more and more money in the economy. It means a stronger economy. Now, here's the paradox. On one side, you see Congress spending, and on the other side, you see the Federal Reserve trying to slow down the economy. We have 2 countervailing forces. They're not really coordinated. The last time they were coordinated was during COVID. And you can see that in the report on page 21. You can see when the value of the plan dropped down, hit that bottom there in March of 2020 during COVID. All hands were on deck. Federal Reserve, Congress, they were now one department, putting all their resources into getting the economy back on its feet. Page 21. And in doing so, they expanded the M2 money supply by about 40%. But look how much the plan in a 2-year period, less than 2 years, reached almost $23 million. And then when they started raising rates, you had 9 months last year, first 9 months of last year, the plan collapsed, right? Both stocks and bonds collapsed. So we haven't seen that kind of unified drop of both stocks and bonds. Haven't seen that. But then you see the right here, you've had 2 consecutive positive quarters. Back to page 4. What's happening now is there is a sense of, because the markets tend to be projected into the future, that we are at pretty close to the end of Fed tightening. Now, where are we on the Fed funds rate? Got 11 increases. We're at 5.25%, right? In 1969, that's where it was. Why is that significant? Because the country was on top of the moon in 1969. We owned we were the best of the best. And we were so proud of ourselves. What a great accomplishment.
Stock market was roaring. We had Fed funds rate like where it is today. We had spent ourselves into oblivion with the Cold War, with the Vietnam War, with the space program. We had a very strong economy in 1969. It's strong now. Now there's weakness, but it's lumpy. It's in different areas of the economy. It's not uniformly weak. It's strong in a lot of areas. So back on page 4, the 3-year average. I hope we can get back to this kind of pace because we had this kind of pace for quite a while. At about 8.3% per year. That's pretty strong. 4.4 million was earned during the last 3 years. Over the last 5 years, plan earned 4.1 million, averaging 4.5%. Of course, this captures, not only the big rise that we just talked about last 2021, 2021, but and a drop in 22, but it captures what happened 2 years prior to that. We already talked about the forced liquidation that occurred. SEI sold off, liquidated the Sykes short-term bond fund. We investigated that. We didn't see any capital or opportunity loss at all to the plan. And the only reason we found out about it was because we were doing our routine check on cash and determined that we had too much cash a couple of weeks after the end of the going into January. And it was a surprise. We did a rebalance back in February, after the February meeting. The large cap growth actively managed product Voya. We recommended that we split half of it off and put it into the index. That was accomplished. We're probably going to recommend you index the remaining piece of it, but we want to wait another quarter to see how well Voya does in this current environment. It's interesting, you look at there are about 5 stocks that are basically running the large cap growth index into 5 stocks. And with Voya, you're spread out into more stocks, so you have less concentration. But by the same token, you're not keeping up with that concentrated pack of 5 names. Let's go to go to page 15 and talk about a couple of these. And you can see on the top what we were just talking about, Voya large cap growth. We go back and look at the 10-year average, 12.8%. It's not a shabby return, but it trailed the index 14.6. Now, this underperformance hasn't been going on for 10 years. We go to page 25. This compares the rolling 5-year returns of Voya large cap growth and the index. And you can see on the first one, this is a 5-year rolling. You can see that Voya, for the most part, was well ahead of the index. And it's just that in the last year or so, you saw this thing drop off. Vertus, sir, back to 15, Vertus, a large cap value. This group is an Orlando group. Fiscal year to date numbers pretty much in line with the index. A little bit behind longer term. That his performance seems to go in and out of favor, as you'd expect with active management. The Spider S&P 600 is new, and that replaced the index. We had a Russell 2000 type product that was in place here, but it wasn't keeping up with the index, so we moved it to a better index that has achieved better returns than the 2000. On page 16, American funds, which is international, obviously, and it was been a great performer relative to its index historically. Had a rough year in 2022, which pulled down its long-term averages, but it's recently shown strong recovery. Most recent quarter up 10 versus 8.6. Not concerned about the product at all. It's doing exactly what we expected. They had some exposure last year to China, and that was the main reason for the underperformance last year. So in the real estate area, we have two different sleeves. You have the REIT, which is these are publicly traded real estate operating companies. It's up 7.5% fiscal year to date, which is good. That's following a disaster year last year when publicly traded REITs got creamed in the first 9 months of last year. But American Core, that's the private piece that was established here. It is now experiencing the wave of depreciation 9 months after the REIT went down. So this is typically what happens. You have one that's priced to market every day, that's the REIT, and then the private piece, there's a lag of about 9 months. So you're seeing that pricing down of American, that repricing is occurring in the office sector. That's where most of the pressure is. I know they have a nice office in Seattle, and I believe Apple was Amazon was the main tenant. Amazon left the property. They've honored the lease, but they moved their people out of that part of Seattle because of a number of factors. But one factor that may be less obvious to you is the taxes. The city has pretty hefty taxes, so they moved. That was another one of the reasons why they. Nice office. It's still leased, but it's not full. People left. More about American. American has exposure to industrial, which is strong. It's the strongest sector. Actually, self-storage is the strongest. And they have exposure in multifamily, which remains strong. Their retail is solid stuff. It's, like Publix anchored strips. That's it. They don't own legacy, big, heavy malls. They're trying to be repurposed. They're not into that. So their pressure is primarily in the office. Pricing. They do own an office worth mentioning in Boston, Cambridge, which is in a heavy medical research part of the country, and it's all medical research, so it's still doing very well. I'm not worried about. Look, we're probably going to see a gradual sort of repricing in several areas of commercial real estate, primarily office and resident and retail over the next 2 years. It'll continue. Retail's been under pressure for quite some time, but eventually it bottoms out, and there are going to be opportunities for them to roll money into those areas that are now, better priced. So I'm not worried about it.
On the fixed income side, it's worth noting that, we have two types of bond programs. One is a high quality, intermediate bond strategy managed by Vertus. And they buy primarily A or better companies. They have some triple Bs. They own agency mortgages, things like that. But it's high quality in general, A or better on average. Then we have a companies that don't meet investment grade are considered high yield, AKA junk. But if you look at the total bond market, you have the huge government bond market, huge agency mortgage market. And then on the private side, on the credit side, more and more companies have fallen below investment grade. And if you looked at the list of companies that index, you'd be amazed at companies that are telecommunications, airlines, lots of companies you've heard of that are in that index. They just aren't A or better. But it's worked out for you. If you look at the comparison between high yield and high quality, the 10-year average is almost 2-to-1 in favor of high yield. If you look at the 3-year, the high yield was 5.2 versus minus 1.9. That's a big difference. And even 1 year. So the high yield has really been except for this most recent quarter, has been a consistent contributor in the bond area. I'll stop. Steve, if you have any questions.
So we're, I think your note was, we're just slightly behind the strategic model, by a little over or under 1%. What does that mean? Are we staying the course, or should we plan on proposed changes to the balances that we have approved?
Yeah, it's both. We have, so kind of, I'm looking at page 8, and then I'm flipping over to back to page 15. So we're still feeling some of the hardship of the Voya large cap growth, because it underperformed in these different periods. And we just made that shift to move half of it. Let's see, on the S&P, on the 600 small cap, that shift is new. So that's already, you don't even have a quarterly return there yet either, because it's so new. So just wait another quarter or two to let these things kind of settle in. American funds, we talked about that fund, that program underperformed. Look at the 1 year, it was down like 2.8 versus minus 0.9. So there's some underperformance there that is, I think, is going to disappear. So I think we've addressed the issues. We just need to wait a little bit longer for things to kind of straighten out. Now, here's the good news. If you look at page 15, we have a lot of money invested in big companies. The Fidelity Large Cap Growth Index, the Voya Large Cap Growth, the Vertus Large Cap Value. These are all big companies. We've got a lot of diversification. I skipped over Cohen & Steers Infrastructure, which is pretty much in line with its benchmark. This is also very much an asset-based company in terms of what they invest in. Cell towers, American Water, American Tower, they own railroads, they participate in airport ownership, toll roads, ports. So these are asset-rich investments that they are in. So I think it's very good to be in this kind of stuff. I wouldn't be surprised as sustainable energy continues to kind of evolve, still in its nascent stages, but as it gets bigger and bigger, I wouldn't be surprised to see more ownership of
of both solar and wind, because it's still getting a lot of subsidy. There are areas in the country want it, and it's profitable. So that's infrastructure.
Any of the other board members have any questions?
What was that?
Do you have any questions?
Yeah, right here.
My only question, back in September, it seemed like we were down $1 million, now we're back up 1.6, I think it is. So we've got a move of.
Yeah, two strong quarters.
Yeah, that's fantastic.
It is.
That's not a question, I just wanted clarification.
No, it's clearly in the numbers. And so look, the market doesn't lie. The market is. When we had the big sell-off in 2008 and 9, it bottomed in March of 09. It was an 18-month crash. Okay? That's how long that decline, it took 18, actually started at the tail end of 07. People forget about that, fourth quarter of 07, it started. So you had a quarter in 07, 4 quarters in 08, and 1 quarter in 09. This one was three quarters. The Fed was very aggressive, and they've continued to raise rates. We have 11 increases, but it looks like the Fed was better prepared this time. They knew what they wanted to do, and they went and did it. And so I think the market is saying, okay, you pound us over the head with a hammer with 11 increases. It looks like they're about finished. And that's why we're seeing some exuberance. Also, the earnings have been surprisingly good this past earnings season. It could be, I've got 11 sectors in this economy. You know, we get focused on one thing like office or retail. Actually, retail has actually picked up because a lot of people are going back to the malls. Really, they are. They get tired of they want to get out of the house. They go out and shop again. And I don't know if that has anything to do with the fact that the shipping orders, FedEx and UPS are shipping less stuff. That's where they got a lot of business. People, they were sitting at home ordering stuff every day. Those checks were coming in, spending on something. But I think we may be surprised to see the recession being much milder. You know, inflation is coming down from 9 to 5. They talk about 2. I don't know if it's going to hit 2 this year. Where did 2% come from? That target? Look it up. Australia. A number of years ago, Australia came up with the concept that if we have 2% in inflation and 4.5% nominal growth, that's 2.5% real growth. That's a good model for the economy. And that principle was adopted throughout the world. That's where the 2% came from. But it may not, it may be that we go to 3%, and we stay at 3% for a while. I don't know. But we're moving in the right direction. Well, I have today.
Okay, well, thank you for the report. If there are no further questions, I'll entertain a motion to accept the mortgage change.
Motion to accept the report as given.
Got a
Second.
motion? Second, any further discussion? Seeing none, all in favor, say aye.
Aye.
All opposed? Passes. All right, do we have Foster on the line?
Yes, we do.
Okay, we'll move back to item number 4 then.
All right, can you guys hear me okay?
Yes.
Okay, can you see me? It doesn't look like you can, but that doesn't matter.
No, we cannot see you.
Okay. Well, do you guys have that 1-page sheet in front of you? Well, I guess first it says rate of expected return vote. And on that issue, you know, every year when we get the valuation report, you're supposed to declare an expected rate of investment return for the next year, the next several years, and the long term thereafter. And Jill mentioned, I think we did that at the last meeting. So you guys could just make that motion today and declare that you expect a 7.4% investment return for the next year, the next several years, and the long term thereafter. And that'll satisfy the state.
Just for informational purposes, what was the expected rate of return for last year?
It would have been 7.5 because, or no, actually 7.4. We didn't change it this year. So it would have been 7.4 last year also.
So to be clear, the recommendation is to adopt a 7.4% expected rate of return.
Exactly.
Okay.
And Burgess can chime in if he'd like to.
Do you have anything to add, sir?
No, no, not at all. I mean, the state of Florida retirement system's at 6.7. Patrick?
I believe so. I haven't looked lately, but I believe so.
It's at 6.7. So you're moving in the right direction. You're moving in a direction that I think we've had this conversation before, that the state is encouraging plans across the state to start moving towards, towards a lower expected return.
Yeah, I finally found the sheet. So it looks like we started at 16 at 8%, and we've been going down a little bit every single year to the now 7.4%.
Correct.
Well, if there are no further questions, I'll entertain a motion. Discussion.
Accept.
Commissioner McCaskill, was that a motion to accept the recommendation for 7.4%?
4, yes.
Okay, we've got a motion. Is there a second?
Second.
Thank you, Mr. Bush. Any further discussion? Seeing none, all in favor say aye.
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 All opposed? Motion passes.
So
All right,
then at the last meeting, you guys had discussion about the funded ratio and the fact that it's relatively similar for the last 10 years. It hasn't had a lot of improvement was the gist that I got out of it. So you wanted to see kind of a history of the funded ratio. And so that's what this chart is attempting to do. So the first line there, 10/1/2012 valuation, you had 16.4 million in assets, but the smooth actuarial value was 16.0. You had an accrued liability of 21.9 million. So your funded ratio that year was 73.1%. And that year happened to be a great investment return year. You got 18.67% investment return. But remember, we use that smoothing of the investment returns to get the actuarial value. So the smooth return, like the 4-year average, was 7.36. And then your total required contribution, the members put in 6%. So if you want to see the city's requirement, it would be 6% less than that. So the city would have been at 29.1% of payroll, but the total was 35.1% of payroll. So then all of the red lines, those were changes that happened. The first red line there, that top one, was a benefit change. So in that year, we increased the normal retirement age from age 50 to age 55. And you used to have a 75% continued to spouse normal benefit, and they eliminated that. So it was a reduction in benefits. So that's why you can see that your accrued liability went down, your funded ratio went up, and your total required contribution rate went down from 35.1 to 33.0. And then the next 3 years, we were really kind of just being helped by that great investment return from 2012. So you can see that your funded ratio went up from 74.5 to 76.6, then 79.1, and then 81.1. And so those were good times. Your your required contribution went from 33.0 to 30.3 to 29.2 to 28.4. And then in 2015, we had a bad investment year. It went negative 2.32. So you can see when we start working that into the smoothing, if you look at that actuarial return, the next 4 years are all below the assumed rate, 6.78, 6.31, 5.35. So, you know, that bad year in 2015 hurt us for the next 4 years. That's the way that the smoothing works. And then, and you mentioned there that we started changing our investment return assumption. So that 2016 line that's red, we made several assumption changes. We reduced the investment return assumption from 8 to 7.9. We changed our salary assumption, turnover, disability, and retirement, because we had done a big study of our assumptions, just like we did last year. And so we made a bunch of changes. So those changes reduced the funded ratio from 79.6 to 76.1, and it increased the funding requirement from 29.8 to 34.2. So those were changes to the assumptions, you know, that didn't have anything to do with your actual investment experience or anything. Those were just assumption changes, and that reduced the funded ratio and increased the funding requirements. And the same thing happened with the rest of the red on the report. You know, when you lower that investment return assumption, well, now you say, oh, I'm further behind, you know, because I don't think I'm going to get as much investment return going forward. So that funded ratio goes down, and your funding requirement goes up a little bit. So I guess the moral of the story is that, you know, your funded ratio is actually 3% higher than it was 10/1/2012. And if we didn't make any of those assumption changes, it would be about 9% higher than that. It would be like 85% funded ratio if we didn't make any of those assumption changes. But then we would be using outdated mortality assumption, and we'd be using 8% investment return assumption. And then in the funding requirements, you know, it's slightly higher now than it was in 2012, but about 8.1% of that, it went up by 8.1% from all those assumption changes. So it really would be at about 28% minus the 6% from the members. The city would really be at about 22% right now if we didn't make any of those assumption changes. But that was a lot of information there, but I was just trying to paint the actual picture of what happened in the last 10 years. You've actually improved in your funded status and your contribution requirement, you know, from the regular experience, but those assumption changes, you know, make it a little bit higher funding requirement and a little bit lower funded ratio. I'd be happy to answer any questions.
Any questions?
No.
Do we know what our total required contribution percentage of payroll is going to be for 2023?
Yeah, I mean, the year we're in right now, the city's funding requirement is 33.6. That goes along with that 39.6 there in the second to last line, because remember, it was the 10/1/2021 valuation that determined the requirements for the year we're in right now. And then the 10/1/22 determined the requirements for next fiscal year. So it's going to go down starting 10/1/2023. It's going to go down to 36.8% total required and 30.8% from the city.
Thank you for that report and thank you for the follow-up.
No problem. I just, hopefully that helped you guys see, where you are and where you've been.
Can we use this number for budgeting? It's set, right?
Yeah, the number for next year is set at 30.8% for the city.
Excellent, thank you.
No problem. I'll sign off unless you guys have anything else, and if something comes up, I can zoom back on.
I think we're good. Thank you very much.
All right, have a good day. Bye-bye.
You too. All right, moving on to item number 6, Klausner, Kaufman, Jensen, Levinson, Anna Parrish, subscription service debt checks.
Good afternoon, everybody. At the last meeting, we discussed that I would reach out to a death check service. I did that and spoke with one of their representatives. The proposal that she returned to me could combine, I should say, all 3 plans because the minimum invoice is for 0 to 500 participants. Using the valuations for the 3 plans combined, it's approximately 372 individuals that it would cover. And that fee would be $3,500 per month, which could in theory be split between the plans. Once the individuals were entered into the system, they could be split up into separate groups, to make it a little less confusing. There would be a dashboard site that Jill would have access to. These death check reports would be run every Monday, and you would get a response by Friday informing you that a match has been found or no match has been found. In the event that a match was found, the source of that information would also be included with a link, a picture, etc. So just to let you know, the 2 other boards, one of them declined to move forward, the other tabled to see what the other boards decided. You are the largest board with, the most participants that this would cover. The other 2 boards didn't feel that it was worth it given their relatively low number of individuals. So as of now, if you decided to move forward, you would have the entire $3,500 cost because it appears that the 2 other boards are not going to move forward.
It's unlikely that an employee is going to die without us knowing about it.
Yeah.
So that 150, 160 people will know about. It's really the remaining general employees retirements, with about 150 of those that are the source for any deaths that may be unknown. And 90% of those people live in Putnam County. So it's unlikely that we wouldn't know in a relatively short period of time. I mean, not that we might not know in a month or 2 months even, but in a relatively short period of time, I'm sure we would know via the newspaper, via other people, if there were a death.
Would you recoup overpayments for people that died and didn't notify you?
Yes, it would go to the pension attorney if they wouldn't work with me, which my assumption is they would, and they have in the past. But if they wouldn't, then the attorney would get involved and they would have means to encourage that.
Otherwise, you
So-
said $1 a year.
Exactly.
Yeah.
I mean, I have questions, but I don't know.
What are your questions?
I'm just curious what fiduciary responsibility we have that's referenced in the report.
We currently, since I took over the pension 5 years ago, we send out every July, we send out a letter to all retirees that they have to send back to me with notarized, because that means they're alive at that point. So that's one thing we've put in place. And if they don't send it back to me, the letter is worded by the attorney such that we have the option of stopping their pension, which will encourage them to contact me too if they're alive. But I haven't pressed that issue. About 90% of the people do get back to me. Some end up calling because they're unable to get to a notary, but it's been a fairly good response.
How much have we overpaid? Or how many times has this happened?
It happened for the police force, a retiree about 3 months ago, and it was 4 months worth before his family contacted us. They made it right. And that's the only time I've seen it in 5 years.
And just for informational purposes, let's say we did do this, does this company insure or guarantee that if there was an overpayment made on their watch, that there would be some remuneration to the city? I don't think so.
I doubt it.
Yeah.
They do stand by their work. I could certainly ask the representative specifically if that were to happen. I think they say that they have, it's either 97 or 99% covered, but that is certainly a specific question that I could get the answer to, if that would, make a change in your decision or play a part in your decision.
Well, I appreciate you offering that, but I think I would ask this board if they're interested in this before we ask you to waste any more time.
Sure, of course.
I'm not interested in moving forward right now.
So
we need this.
seeing and hearing consensus, I would entertain a motion to put this to rest.
I shall move.
Okay, so move not to move forward with the subscription service for death checks. We have a motion.
Second that.
All right, motion is second. Any further discussion? Hearing none, all in favor say aye.
Aye.
Opposed? Motion passes. Okay. I think we got a report on House Bill 3.
Yes, I just wanted to give a quick overview on the highlights of House Bill 3 as they relate to pension funds. As you'll see in those first set of bullet points, House Bill 3 essentially mandates that investments cannot be made based on non-monetary considerations. So no social, political, or ideological interests, which is referred to in the bill as ESG, should be considered by investment managers when making decisions. Those same rules will apply when voting proxies, and a comprehensive proxy report will be required. The Division of Retirement will provide more information on those reporting requirements, which we will keep you up to date with. Just something to keep in mind, I don't think that this will have any impact on you, as I highly doubt your investment managers are focusing on anything other than, making good monetary investments. But something to be aware of, there's some new language that needs to be included in investment manager agreements going forward. We will handle that on our end. And like I said, keep you up to date as soon as more information is coming out on this, which based on some emails that are circulating between the attorneys of our office, I think an updated memo with some additional guidance is in the works. So as soon as that is ready, we will send that out, and update you with any new information that comes our way.
Thank you for the summary. Any other follow-up questions? Okay. Just a note here, I now know what pecuniary factors mean. Differently put it, yeah. Been a day for words. All right. Number 7, fiscal year 24 budget. Skyler?
Yes. The budget has a few points. The ARA fees are new for this year. That's the real estate investments that we're having. So those are new fees to the budget. And dropped off the budget was the SEI Cohen & Steers fees, because we moved into a product that is more like a mutual fund without those kind of fees. So one has replaced the other. Foster and foster fees are noticeably higher, but that is, they explained earlier in the year, I think in September, that their fees were going to be increasing. Otherwise, most things have stayed the same. Still, 3 trustees one each can attend a conferences. And the other pension, the last pension, the police pension, asked Burgess and Sawgrass, one of their other investment people, managers, to put on a workshop, to an educational workshop for free for the board members. So instead of attending a conference and expending that money, it might be more convenient and more useful to have it like one day, one time for all the board members. That
The FPBTA is a conference that we support and we present. So I'll bring a piece that we've put together for them. So, and Anna will speak on a topic. And I think if all 3 boards were here, it would only take an hour. And maybe we could do it over lunch. I don't know, maybe bring the sandwiches in again. It's a great idea. And just we'll go from 12 to 1. How's that? And then that would not be your regular meeting. That's just a workshop. And we've done this with other. You have to be here, Mr. Bush. Can't be in North Carolina.
Be here.
But we've been doing this for years with smaller plans, and your attorney, I'm sure, will agree that it's okay to do it. It's a good idea.
And that was my question, is council, is that something that we can legally do?
Yes, absolutely. It would be noticed, just like it was a meeting, but it would state on the notice that it was purely educational in nature and that no board business, no specific board business or decisions would be made because then there would be a sunshine violation. But as long as it's educational in nature and you notice it that way, then you have no problem.
Thank you.
So I'll entertain questions. Budget, I've got one. So fees associated with a specific investment allocation, are they taken into account in the actual percentage that's reported to us in the report? So for instance, the 14,400 for the American Realty, is that factored into the net gain?
Oh, yeah, absolutely. Yeah, because in your report, you have a growth section and a net section. Yeah, good question.
Any questions? If not, I'll entertain a motion to accept or adopt fiscal year 24 budget. I'll move. We got a motion. Is there a second?
Second.
Commissioner, any further discussion? Brett, I see you studying over there.
Yeah, I've got a question. I'm sorry. When it comes to budgets, I like to see what it was prior year compared to this year. Is it going up or is it? I don't see that.
no, you don't.
I don't need to be a stickler.
No,
I'm looking for
last year,
Are you taking last year's budget and just using those numbers again?
no,
I suspect that last year budget was below, I'm sorry, last year's fiscal year actual was below budget. Because the market value sensitivity.
yes, because some of the fees are based on the fund balance.
Yeah.
So if the fund balance goes down, so do the fees, like Burgess's and Capital City. I think SunTrust is flat. That's a flat fee.
Do we know if our operational costs in that second category are the same as last year?
Admin went up because of Foster and Foster. That's up about $2,500. Attorney fees, I'm up $500, though we haven't been spending that much. If we go to the audit, that stayed the same. The schooling has $300 more in it. The plan administrator stayed the same. Postage and supplies, that's gone way down. Oh, because it was combined with the plan administrator, separate from the postage and supplies. Fiduciary insurance went up $500. The biggest increase is Foster and Foster, but that was announced 9 months ago and agreed to.
Anything further? That we did.
Yeah.
All right. Seeing no further discussion, all in favor, say aye.
Aye.
All opposed? None. Motion passes. Jill is number 8U.
Yes. No, it won't let me vote. Not allowing me to rotate it without spending money.
It's like going to an exercise class.
So, admin, I mean, the expenses,
Turn the screen around.
I can't, I wish I could.
No, no, the one on the-
Yeah. Big money coming out, not really. The new ARA investments are costing. But like I say, even those that weren't budgeted, we had SEI budgeted, so they offset each other. The bold are the contribution returns from people who have resigned, both in the gas authority as well as here. So some of the names might not be familiar to you. But yeah, nothing out of the ordinary.
We don't need to accept this as a report.
Yes, you knew that.
Make a motion to accept the report as given.
There's a motion. Got a second? Any further discussion? Seeing none, all in favor, say aye. Aye. All opposed? Motion passes. Right, public comments. Right. Packed house today. Okay, we'll move on to other business, Form 1 email address.
Yes, just a reminder that each of you on the board has a Palatka-fl.gov account that you should be able to log into. Sunny is following the state of Florida statute regulations that all board members have a email account that is tied to the city that they're a function of, a board member of. So each of you do have it, and if you don't have your login and password, please ask Sunny because she has the login and passwords for you.
So this is separate about Palatka Gas Authority.
Yes, because you're on this board, your Form 1s are now going to be emailed to you, and you have to email them back using that same
So
account.
just taking it to the county is not enough.
Not anymore. They've stopped doing that, is what Sunny has explained to me.
Why did they send me a hard copy?
I don't know. They're transitioning, and they've been transitioning. It was a statute a couple of years ago, and now they're starting to enforce it.
Drop it off.
The same.
No, I'll take it over.
Well, I already did that. I already did, please.
So, but like I say, Sunny is in charge of that.
Okay.
So do look at it, because I also send emails. I mean, I'm still sending it to your other email addresses too, but I also send it to your.
Have you sent it?
Have I sent Form 1? No, I've sent other documents like the meeting notices here. So, and our next meeting is on August 29th at 3 o'clock, normal time. So Hopefully, one of the other board members wanted the information to them earlier than a week before. So I'm supposed to be working with the presenters to get the information here 2 weeks before.
Can I just ask an informational question?
Sure.
Since Don retired, he's not still on the board as a retiree.
No,
Okay, so the new city manager.
he could be voted on.
Well, I'm gonna go back to my old seat, so you don't have to worry about it.
Yeah,
Okay.
yeah. Once the city manager, city manager is here
Yeah.
permanently, they will be on the board. And but Jonathan has a seat as both
No, he
now.
does not.
Don't you worry.
All right.
Then we'll have a more full board too.
Yes.
All right, well, thank you for that report, Jim.
Sure.
That concludes our business. I'll entertain a motion to adjourn.
So move.
All right, we stand adjourned.
Mhm.